My voice is audible, no, properly? Screen is visible? Okay. So, today we are going to discuss the balance part of salary and we'll try to finish this chapter. If at all something will remain, that will not be a big part. So, today we'll finish almost the major part of salary. It will be over. Okay. So, see, yesterday we discussed about all the perquisites till clause 8 and then we solved few questions also yesterday. Okay, getting some confidence by solving those questions, that whatever we have studied, how that is asked in the question and how we are actually able to apply the concepts in the question. Okay, so today you will get more clarity about that thing, but before that we'll be discussing few things and then again we'll go to the questions. Okay, so first let me discuss few things with you, then we are going to solve the questions, but I will be taking up those questions first which I gave you in the homework yesterday. Okay, now pay attention. See, if the employer gives medical facility to the employee. Now, what is the meaning of this medical facility? First of all, medical facility means the cost of treatment might have been met by the employer, or the cost of treatment you incur, employer will reimburse you. Meaning, there might be some medical treatment going on, and for that medical treatment, whatever cost is to be incurred, that is incurred by employer. It can be incurred directly by him, he can directly make the payment, or you make the payment, he can reimburse you also. In both the ways, you are getting a personal benefit. Okay, so here now, in case of medical facility, this is usually what it is given for treatment of patient. Now by patient, what do I mean? Who should be the patient? So the patient can be employee himself or employees, spouse, children, or employees dependent, brother, sister, or parents. So nowhere it is mentioned that spouse and children should also be dependent. No, they can be dependent also, they can be independent also. But the brother, sister, and parents, what did I say? The brother, sister, and parents must be dependent on the employee. Dependent brother, dependent sister, dependent parents. So any of them can be the patient. Now they are patients. So for their treatment, the employee is getting some benefit, meaning that treatment cost, etc. is met by the employer. So whatever treatment is happening, now treatment is happened in India. And that treatment in India must happen in G for government hospital, R for recognized hospital, and E for employers hospital. G for government hospital, R for recognized hospital, meaning those hospitals which are recognized by the income tax department. That means these hospitals do exist. Even the income tax department knows. Recognized by the income tax department. Yes or no? Or the hospital can be a hospital belonging to the employer. See, by hospital, I don't, mean only hospitals. It can be clinics also. It can be nursing homes also. It can be, a small type of clinic also. Yes or no? So any clinic can be there. Any nursing home can be there. Even the hospitals can be there. But they are government. These hospitals, etc., are government hospitals, recognized hospital, or employers hospital. So in India, the treatment is happening. Treatment should happen for these patients. And the treatment is happening in these type of hospitals. So for this treatment in India, in such hospitals, whatever medical facility is given, that medical facility, that benefit is fully exempt. Whatever may be the amount paid by the employer for that treatment. If it is 2,000, if it is 5,000, if it is 10,000, if it is 50,000, it will be fully exempt. That means the taxable value of perquisite here will be nil. So exemption is given for medical facility. And this we are doing 17 subsection 2. There is a proviso. Proviso to section 17.2. In that proviso, it is written that if such type of benefit is given to the employee, then this benefit will be fully exempt. Meaning that if the treatment happens in India in any other hospital for the same patients, then it will be fully taxable. Whatever amount paid by the employer or reimbursed by the employer will be fully taxable in your hands. Because even if the treatment is happening for the same patients, even if the treatment is happening in India, but the treatment is not happening in GRE. Getting my point? What if the treatment is happening is in GRE, government hospital, recognized hospital or employer's hospital, but the treatment benefit is happening for any patient other than these patients, then also it will be taxable. Meaning that if you want to claim the exemption for this medical facility from the employer, both the conditions must be fulfilled. That the treatment must happen here for these patients, and for this treatment of these patients, whatever medical facility given by the employer to the employee will be fully exempt. Only then it is exempt. Yes or no? So meaning that if treatment in, and I am writing patients, okay, treatment in India in GRE, and patients can be employee or employees, spouse, children, dependent, brother, sister, parents. Okay. Now this is the first condition and this is the second condition. This is there. This is also there. Hello sir. Both the conditions are fulfilled now. Only then medical facility, that the benefit will be what? Exempt. Yes or no? Now what if this is there, this is not there? Or this is there, this is not there? Or this is also not there, this is also not there? In all these cases, the benefit will be taxable, fully taxable. Got it? Treatment happening in GRE only, but it is happening for a patient other than specified patients, taxable. Treatment happening for specified patients only, in India only, but other than GRE, then also fully taxable. Treatment for other patients in India, in other hospital, then also fully taxable. Got it? Sure. Now let's move on to the next point. Next point. Somebody might ask that, sir, what if the treatment is happening outside India? For these patients, it is not necessary that the treatment will happen in India only. What if the treatment is done outside India? Then can there be any exemption? The answer is yes. Then also there is exemption. Wait for a second. I'll tell you. What I'll do, I'll copy the same part. Okay, now. Same to same part I have copied. And now I will write it down here. Now, for example, the medical facility is happening, medical facility is given for these patients for their treatment, and treatment happens outside India. Now, for this treatment outside India, the employer can meet the cost of what? Treatment also. Employer can meet cost of stay also, and employer can meet the cost of travel also. See, whatever treatment cost met by employer, is it a personal benefit? Yes, it is a personal benefit for the employee. Yes or no? This is a personal benefit. Whatever cost of stay met by the employer, that is also a personal benefit for the employee. Whatever cost of travel met by the employer, that is also a personal benefit for the employee. Are you all getting my point? What I want to tell you all here? Hello, sir. Now, see, these two personal benefits, cost of treatment and cost of stay, whatever amount is met by the employer is a benefit. This personal benefit will be exempt up to limits prescribed by RBI. So there is a limit fixed by RBI to incur such type of expenses. So if the employer is meeting the cost of treatment and cost of stay to the extent of limit fixed by RBI, because see, foreign currency will be involved, no? To get the treatment done outside India and to stay outside India, foreign currency will have to be spent. So how much foreign currency can be spent for treatment? How much amount can be spent for treatment? How much amount can be spent for stay? There is RBI limit for that. And to the extent of this RBI limit, if the employer is meeting your cost, if the employer is giving you that benefit, then it is fully exempt. But what if the employer is meeting the cost in excess of this RBI limit? Then up to RBI limit it will be exempt, and any excess amount met by the employer for cost of treatment and cost of stay, that will be taxable. Excess amount will be taxable, right? So exemption up to the limit prescribed by RBI. If benefit for cost of travel, cost of treatment and cost of stay is more than such RBI limit, then excess amount will be only taxable. Got it? This one will you remember? Now, as far as cost of travel is concerned, employer might incur the cost of travel for the patient. So whatever cost of travel which the employer has incurred is a personal benefit. But either that will be fully exempt or it can be fully taxable also. So when the benefit of cost of travel will be fully exempt? If the GTI of the employee is up to 2 lakhs, then the benefit is fully exempt. However, if the GTI of the employee is more than rupees 2 lakhs, then that benefit will be fully taxable. So first of all, we'll have to calculate the GTI of the employee. In that GTI, we'll take salary, we'll take house property, we'll take all the 5 heads of income, then we'll do clubbing, set off, GTI will come. If that GTI amount of the employee is 2 lakh or less, then the cost of travel benefit will be fully exempt. But if that GTI amount of the employee is more than 2 lakhs, then the cost of travel benefit will be fully taxable. Now to calculate this GTI, we have to take all the 5 heads, including the salary head, yes or no? But under the salary head, what you are going to do? You are supposed to consider everything other than this cost of travel benefit. Because this cost of travel benefit is taxable or not, that only we are going to find out, no? Yes or no? So leave this cost of travel benefit, and without this cost of travel benefit, calculate the salary. That salary, other 4 heads will give you what? GTI. That GTI should be 2 lakh or less. Only then the cost of travel benefit will be exempt. Got it? And if that GTI is more than 2 lakhs, then the benefit will be fully taxable. Got it? Everyone. Now this benefit will be available only if the treatment happens outside India for these patients only. But what if the treatment happens outside India for other patients? Then all these benefits will be fully taxable in the hands of employee. Given for any other patient will not be exempted. Given for these patients will be fully, given for these patients only can be exempted, and exempted up to these limits only, like this only. Getting my point? So can I say, if the treatment happens outside India, and that treatment should happen for specified patients, and who is a specified patient, guys? Either the employee or employees, spouse, children, dependent, brother, sister, or parents. So if the treatment is done outside India and for these patients only, then only what is going to happen? Come on, tell me. Then only the exemption will be available. Then cost of stay, first of all, cost of treatment, cost of stay, and cost of travel can be treated as exempt. Hello. So the exemption here will be up to RBI limit. This will be either fully taxable or fully exempt depending on GTI. Got it? Here what you will be seeing? RBI limit, and here either it is exempt or it is taxable, which depends on GTI. Done? But if any of these conditions are not fulfilled, then such exemption cannot be taken. Then the benefit will be fully taxable. Will you remember this? Sure, everyone? Very good. Now pay attention. If the employer is making the payment of premium on health insurance policy. Sometimes this health insurance policy is also known as mediclaim policy, yes or no? So we call it mediclaim policy. So mediclaim policy, the premium will be paid by the employer. To whom the premium will be paid? Come on, tell me. The premium will be paid to insurance company. But that premium is paid for the health insurance policy of employee or employees, spouse, children, dependent, brother, sister, and parents. Then whatever premium paid by the employer on the health insurance policy for these persons, that premium will be treated as exempt perquisite for employee. This will be exempt perquisite for employee. Therefore, taxable value here will be nil. Meaning that if the premium is paid to the insurance company for any other person, any other relative of the employee, then that premium will not be treated as exempt perquisite. That will be taxable in the hands of employee. Yes or no? So can I say if the mediclaim policy premium is paid by employer for any other relative of the employee, then it will be fully taxable perquisite. That means whatever amount paid by the employer for that policy as a premium, that will be fully taxable in the hands of employee. Will you remember this? Sure? Okay. Now, coming to this part, if the employer is paying premium to the insurance company, again he can give the premium. Now the premium is not paid on health insurance policy. Now the premium is paid on personal accident or group insurance policy taken for employee. So if the personal accident policy taken for employee or for all my employees, there is a group insurance policy, and for that group insurance policy or that personal accident policy which is taken for my employee only, whatever premium I am paying, that premium will not be a perquisite taxable in the hands of employee. That is an exempt perquisite in the hands of employee. Why? Because that premium is not given, not paid to give the personal benefit to the employee. That is to safeguard myself, that God forbid if something happens in the future, some personal accident etc. happens in my factory or my company, and if the employee loses his life or employee becomes handicapped etc., so I will have to give him the compensation. So I'm shifting my liability to pay the compensation on the insurance company by paying that premium. So that premium is not paid for giving the benefit to the employee. That premium is paid to safeguard myself from that future event. Yes or no? How can that be treated as personal benefit? That is not a personal benefit, fully exempt. Go. Yes or no? Will you remember? Perfect. Now, pay attention. One more thing. What if the premium is paid on the life insurance policy of the employee or any of his family member? Now the premium is paid on what? On life insurance policy of the employee. Life insurance policy of employee or any of his relatives, family members, etc. Then it will not be an exempt perquisite. If you remember, this will be fully taxable as perquisite. Clause 5. Do you remember? In clause 5, this premium was taxable. Now pay attention. Whenever you pay the premium for life insurance policy, that premium is allowed as a deduction under 80C. Which section? 80C. But that premium should be for yourself your spouse and your children, then that premium is allowed under section 80C. So wait, here whatever premium the employer is paying, if he pays that premium for yourself, your spouse and your children, then that is a taxable perquisite for you. But later on it will be allowed under 80C also. Getting my point? But if the employer is paying the premium for any other relatives, then it will be taxable here as a perquisite, but it will not be allowed under 80C, because for under 80C, the life insurance premium of individual HUF or children is only allowed, and for not other relatives. Getting my point? So that premium you will not be able to claim under 80C. So here now, along with this premium, I will write that premium on the life insurance policy can be claimed under section 80C also, subject to certain conditions of 80C. So conditions of 80C are also getting satisfied, then this premium can also be claimed over there. So what was the condition there? 80C, your premium, your spouse premium, your children's premium paid will be allowed there. So either you pay from your income or tell your employer to pay, which will become your taxable income, that will be allowed under 80C. Yes or no? But what if you are paying for yourself? You are paying for any of your relatives, will not be allowed to you. So even if it is paid by your employer, treated as your taxable salary, still it will not be allowed under section 80C. Getting my point? Sure. So life insurance premium for whom? Employees, spouse or children, or other relatives or family members of employee. Now, if it is paid by employee or paid by employer. If it is paid by employer, what you will do? If it is paid by employer, you will do two effects. You will give two effects. What? First, it is taxable as income from salary as a perquisite. Yes or no? Then for that you will get 80C deduction also. And for this, you are only going to get 80C deduction. Got it? But wait, here, same to same. Copy paste. For other relatives of the employee, what will happen? Come on, tell me. For other relatives of the employee, if the employee himself paying, then also not allowed. And if the employer is paying, first it will be taxable as perquisite, but then 80C deduction cannot be claimed for that. Got it, sir? This thing I am going to ask you in 80C. You are supposed to give me the answer about this thing. Sure. Now, here, can you see this life medical insurance premium? For this medical insurance premium, deduction is available under section 80D, subject to conditions. But wait. You are not going to claim the 80D deduction for this premium. Why? Because under 80D, when you will go now, in 80D they are saying that you have to make the payment of that premium for yourself, spouse, dependent children, dependent parents. Any parents, dependent or independent. So the medical insurance premium for yourself you have to pay. For your spouse also you can pay. For your dependent children also you can pay. And even for your parents you can pay. That will be allowed under ATD. But that has to be from your taxable income. Out of your taxable income you have to pay that. Getting my point? Hello sir. Medical insurance premium for any other person cannot be claimed as deduction under ATD. Now tell me, can your employer pay the medical insurance premium for yourself, your spouse and dependent children? Yes. But that is going to be fully exempt for you. And that amount which is not treated as your taxable income, how can that be claimed as deduction under ATD? Can it be? No. So don't claim that under ATD. Hello sir. What if the employer is paying the premium for your independent children? Employer is paying your premium for independent children. That is not a perquisite for you, not taxable for you, but that you cannot claim under ATD, because under ATD the premium for your dependent children only can be claimed, and that has to be out of your taxable income. Hello sir. Can your employer pay the premium for your brother, sister dependent on you? Yes, that will be exempt here, but that you cannot claim under ATD. Hello. Can your employer pay the premium for your independent brother, sister? Yes, that will be taxable here, but that you cannot claim under ATD. Under ATD, only for yourself, your spouse and dependent children or parents, you can claim. Hello sir. Here, this is exempt. Exemption you know. Now, along with this exemption, you have to also see ATD deduction. So exemption is available if the employer is paying the premium for myself, my spouse, my children, dependent or independent, or my dependent brother, sister and parents. So what if the employer has paid the premium for all of them? Is it my taxable income? Is it my taxable perquisite? No, fully exempt. Will I be able to claim this premium under ATD? The answer is no. Under ATD, I cannot claim this, because to claim deduction under ATD, that premium should go out of my taxable income, and this is not my taxable income. Getting my point? So what if employer is paying for you? First, employer is paying medical premium for you. Exempt for you. You cannot claim it under ATD. Even if it was paid for you. Why? Because the amount did not become taxable for you. 2. If the employer is paying for your spouse, dependent or independent, will not make any difference, fully exempt. And that also you cannot claim under ATD. What if the employer is paying for your dependent children? Not taxable for you and not allowable under ATD also, because it is not taxable. Hello? What if the employer is paying for your independent children? Not taxable for you here, and there also you cannot claim. Why? Because ATD, the deduction is for medical premium paid for dependent children, and that too also out of taxable income. First, this is not taxable also, and second, the children are also not dependent. What if the employer is paying for your dependent brother and sister? Fully exempt, not taxable. And even if it was taxable here, still you could not claim it there under ATD. Why? Because under ATD, it is available only for self, spouse, dependent children and parents, and not for any other relative. What if brother and sisters are independent and the employer is paying? Then that premium will be taxable for you under the head salary. But that cannot be claimed still under ATD. Getting my point? What if the employer is paying for your parents who are dependent on you? Fully exempt here. And that you cannot claim there because the amount is exempt. Hello? But the last case, if the employer is paying for your independent parents, now that will not be exempt perquisite, now that will be a taxable perquisite. And that amount you can claim under ATD, because under ATD, parents premium will be allowed whether the parents is dependent or independent, provided that amount was taxed, provided that is coming out of taxable income. So is it getting taxed now? Yes. Your independent parents premium paid by employer, is it taxable? Yes. And now that you can claim under ATD also. Got it, everyone? So when I'll be teaching ATD, no, that time I'll connect this point over there. Will you remember by that time? Sure, no? Very good. So this was your medical facility as per proviso to section 17.2. Will you remember? See, medical facility is taxable only. Medical facility given by the employer is taxable. But when are you going to take the exemption, that you have to remember. If the medical facility is provided by the employer for treatment of specified patient in India in GRE, then that medical facility fully exempt. Otherwise, it is taxable only. Hello, sir. If the medical facility is provided by the employer for treatment of specified patients outside India, then whatever cost of treatment met by employer, whatever cost of stay met by employer will be exempt, but it will not be exempt fully. It will be exempt to the extent of RBI limits. Both the expenses, yes or no, made by the employer will be exempt to the extent of RBI limits. But if the cost of travel is also met by the employer, when the treatment of specified patient was done outside India, cost of travel was also for that patient met by employer. Even that is also a personal benefit, but that personal benefit will be either fully exempt, fully taxable, depends on GTI. If GTI is 2 lakhs or less, this travel benefit will be fully exempt, and if the GTI is more than 2 lakhs, travel benefit will be fully taxable. This exemption can be taken like this. To these extents, the exemption can be taken only if the treatment is done outside India for specified patients. Now, can I say here, I remember one more point here. See, if the treatment is happening outside India, so treatment should happen for these patients. Done. Then for the patient, this benefit employee is getting. Treatment of the patient, stay of the patient, travel of the patient. So these benefits are given for this patient to the employee. Then it will be exempt to the extent of this much or this much. But what if the treatment is happening outside India? Treatment cost of the patient, stay cost of the patient, and the travel cost of the patient met by the employer. Along with that patient, some attendant is also going on. Can there be an attendant along with that patient going with that patient outside India? Yes. So for that attendant also, the employer can incur travel cost. For that attendant also, the employer can incur stay cost of stay. Yes or no? For that attendant, treatment cost will not be met because attendant is not going for his own treatment. Hello. So attendant will be accompanying the patient. Who can be the attendant? Attendant can be any person. Attendant can be grandfather, attendant can be brother, he can be friend, any person. Any person going as an attendant with the specified patient. For that attendant also, the employer can give you this benefit. Cost of stay as well as cost of travel. So will that benefit for attendant given by the employer to you, will it be exempt? The answer is yes, even that will be exempt. Cost of stay of attendant can be exempt if met by the employer to the extent of RBI limit. Cost of travel of the attendant met by the employer can either be fully exempt or it will be fully taxable. Hello, sir. But it will be exempt only for one attendant, huh? Only one. So can I say, see here, cost of treatment, cost of stay, and cost of travel. This is given by whom? Employer meets this cost. So employer is meeting this cost for whom? For patients, specified patient. Then this can be exempt, this can be exempt, this can be exempt. First two exempt up to RBI limits, last one exempt fully if GTI is up to 2 lakhs. Yes or no? Otherwise the last one will be fully taxable. Yes or no? Now the employer is giving the benefit of cost of stay and cost of travel for attendant. For attendant, cost of treatment will not be there. So I will write not applicable over here. Not applicable. And for how many attendants the employer can give you this benefit? No, employer can give you the benefit for all the attendants, but the exemption will be available only for one. Your employer is mad. He can give you the benefit for all the attendants. But we are not mad that we are going to give you the benefit for all the attendants. Yes or no? So if the benefit of cost of stay and cost of travel for attendant is given, so for any one attendant, this benefit and this benefit can be exempted. For all the other attendants, whatever benefits are given will be fully taxable. Will you remember this? Sure. Medical facility done. So now there is one question on medical facility. Go to your illustrations first. Question number 13. Illustration number 13. Come on, pay attention. Compute the taxable value of perquisite in respect of medical facilities. So different medical facilities are given to the employee. The name of the employee is G, Mr. G. Okay. So out of these, how many medical facilities will be exempt? Forget about them. And how many will be taxable? Take them, get the total, you will get the taxable value of the perquisite. Yes or no? So first one, medical premium paid for ensuring health of Mr. G. Health insurance premium paid by the employer for Mr. G, for employee. Taxable or exempt? Exempt. So not taxable. We'll put across. Treatment of Mr. G by his family doctor. Okay. So treatment is done outside India? No. Meaning that the treatment must be done in India only. But this treatment is not happening in GRE, government hospital, recognized hospital or employer's hospital. Hence, this benefit given by the employer will be taxable. Yes or no? It will be taxable. Next one, treatment of Mrs. G in government hospital. Very good. The treatment is happening in India also and government hospital also. And the treatment is happening for specified patient. Mrs. G means spouse. Yes or no? Then it will be exempt. Next one, treatment of G's grandfather in private clinic. First of all, treatment is not happening in GRE. And second, the treatment is also not happening for a specified patient. So this benefit will be fully taxable. Next one, treatment of G's mother, 68 years and dependent parent, meaning the treatment is done for a specified patient. But the treatment is happening in India, not in GRE, by family doctor, then it will be fully taxable. Yes or no? Next one, treatment of G's sister who is dependent on him, dependent sister, but the treatment is happening in a nursing home run by government, recognized employer? No. So nursing home will be a private nursing home. Hello? So this will also be taxable. Now, treatment of G's brother who is independent. Very good. So independent brother, even if the treatment was done in GRE, still it was taxable. The brother should be dependent. What if the brother was dependent? Then also it was taxable because the treatment is not done in GRE. They have not mentioned it. Yes or no? In both the cases, it is taxable only. Hello, sir. Next one. Treatment of G's father, 75 years and dependent. Meaning that G's father is what? dependent parent, and the treatment is done abroad. What was the cost of treatment? 50,000. So cost of that treatment 50,000 is met by employer. Is it a benefit? Yes. Benefit for cost of treatment is 50,000. Then benefit of cost of stay is 30,000. See, 50,000 will be exempt if it is within the limit of RBI. 30,000 will be exempt if it is within the limit of RBI. But for these two, separate limits should be given, RBI. But they are saying that limit specified by RBI is 75,000, not mentioned that this 75,000 is for which one? Hello? Then we will have to assume that this 75,000 is the combined limit for these two expenses. If you want us to claim the exemption separately, give us the separate limits, no? If you are not giving the separate limits, what we will assume? That this RBI limit is combined limit for both these expenses taken together. Hello, sir. So in that scenario, what will happen? 80,000 benefit and 75,000 RBI limit. How much will be exempt? 75,000 will be exempt, and here only 5,000 will be taxable. Yes or no? So on your calculator, you are going to take 5,000 plus 12,000, 17,000 plus 8,000 will give you 25,000 plus 3,000. It will be 28,000. 28,000 and 6,000 will be 34,000. 34 plus 5, it will be 39,000. So taxable value of this perquisite will be 39,000. Everyone got this? Sure? Should I move ahead? So this was medical facility. Any of these cases, one case can come in your main answer, main question. In the salary question, any one of these adjustment can be given. Got it? So now let's come to the next perquisite. The next perquisite is LTA, also known as LTC. So the full form is leave travel assistance or leave travel concession also you can say. So what is LTA, LTC? It is an amount given by the employer to the employee to meet the cost of journey. Cost of journey means ticket fare. While the employee is on vacation with or without his family. So some amount will be given by the employer to buy the travel tickets when you will be going for vacation. So you can go on a vacation on your own, alone, or you can go on a vacation with your family also. So when you are on a personal tour, when you are on a vacation, so you will be going and you will be coming. So to go and to come, you will have to spend some money on ticket fares, no? Bus tickets, railway tickets, air tickets. So to meet the cost of that travel, to meet the cost of that journey, that ticket fare, the employer might give you some amount. And that amount which is given by the employer to meet that ticket cost, no, ticket fare, is known as what? Leave travel assistance. Okay. Now this leave travel assistance is a personal benefit for you. Yes or no? So this LTA given by the employer can be exempted under section 10 subsection 5. So you can take the exemption for LTA. Now the exemption under section 10.5 will be for LTA or LTC which is provided by employer for employee or employees, spouse, children, dependent, brother, sister, parents, to meet cost of journey, meaning ticket fare, and this journey shall be done to a place in India. So two important conditions are there. The LTA which you are getting from your employer, if you want to claim that LTA as exempt under section 10.5. So 10.5 will give you the exemption of only that LTA which your employer is giving for yourself, for your spouse, for your children, for your dependent brother, dependent sister or dependent parents. For these persons only the LTA given can be exempted. Meaning the LTA given for any other person will be fully taxable. No exemption. And for these persons also the LTA given should be given for their journey to a place in India only. So if the LTA is given to meet the cost of travel tickets for the journey which is performed to a place outside India, that will be fully taxable. Even if it is given for these same persons. So two conditions. Number one, journey. What did I say? LTA or LTC for what? Journey in India, and for employee or employees. Come on. Spouse, children, dependent brother, sister, parents. Okay. So if it is given for journey in India and for these people, only then the exemption can be taken. But what if it is given for a journey in India and not for them? Then it will be fully taxable. What if it is given for these people but for journey which is performed to a place outside India? Then also fully taxable. Hello sir. And what if it is given to the employee for any persons other than these, any other persons, for the journey performed outside India? Then also fully taxable. Yes or no? So this is also not satisfied, this is also not satisfied. Then it will be fully taxable. Here only you can claim the what? Exemption under section 10.5. Here only in this case, the exemption can be given. Only in this case, if both the conditions are satisfied. In all these cases, it will be fully taxable. It will be fully taxable in these three cases. So if the employer is giving you some money, that okay, take this money, per head I am giving you 10,000. 10,000 for you, 10,000 for your spouse, 10,000 for your one child, 10,000 for your another child, 10,000 for your dependent brother, 10,000 for your dependent parents, 10,000 for your dependent sister. This is what? Out of this 10,000, spend money on your travel tickets. Travel tickets you will have to buy, no? Because you are going on a journey, you are performing a journey, you are going on a vacation to a place in India. And for that, if this 10,000 is given, then the exemption can be taken. Now the question will be, we know that when the exemption will be available, to get the exemption, two conditions are important. But how much exemption is available? How much? How much exemption will be available? So A, B, C, whichever is lower. And you are aware, first limit should be actual amount received. Hello. So I will write actual amount of LTA can be exempted maximum, or actual amount spent on the journey. Your exemption cannot be more than amount spent. Hello. And the last thing is maximum limit in IT rules. And there is one rule, rule 2BA. In that rule 2BA, we will come to know that what will be the maximum limit of exemption. Got it? So we'll have to pick one value from IT rules. IT rules maximum limit will be given. Your exemption cannot be more than this amount, or the amount you are actually spending, or the amount which you are actually getting, whichever is lower. Hello? 10,000 was the LTA. So limit A will be 10,000. Amount spent by you on that journey was 12,000. So limit B will be 12,000. And the maximum limit which you calculated, that maximum limit was only 7,500. So 10,000, 12,000, 7,500, whichever is lower, 7,500. So out of 10,000, take the benefit, take the exemption of 7,500, the balance will be taxable. Getting my point? What if 10,000 is received? Amount spent by you, actual amount spent by you for that journey was only 5,700. And the limit was 15,000. So 10,000, 5,700, 15,000, whichever is lower, 5,700 amount actually spent. Then the maximum limit will not be available. Then the amount which is received will not be exempt. Amount only spent, to that extent you can claim the exemption. Hello sir, getting my point? So tell me one thing. Would you like to know the limits given in IT rules? So rule 2BA prescribes the maximum limit for exemption under section 10(5). But how much will be the maximum amount of exemption, maximum limit? That is based on few questions. Few questions will be asked. Your answer will be either yes or your answer will be no. So if your answer is yes, then this much is exempt. If your answer to that question is no, then you will go to another question. So first question is asked, that is the journey performed, the journey for which you are getting LTA. Okay, you are taking the LTA to perform a journey, no, to a place in India. So the LTA received is for that journey which you are performing by air. So if the answer is yes, then the limit will be given. But if the answer is no, then second question will come. Yes or no? So if the answer is what? Yes. So the exemption will be to the extent of maximum economy class airfare of Indian carrier by shortest route. So whatever may be the economy class airfare of the Indian carrier by the shortest route, that will be the maximum amount to which your LTA can be exempted. Either that amount or the amount which you have actually received or the amount which you have actually spent on that journey which you have performed by air. There are two classes, no? Business class and economy class. You know, you are not supposed to take the amount of business class. You are supposed to take the amount of economy class. And economy class fare, airfare of Indian carrier. Indian carrier means any airlines operating in India. And which airlines operating in India the government will rely on? Indian Airlines, which is not reliable at all as of now, but still, for the purpose of this, the government will be relying on the economy class airfare of Indian carrier, means Indian Airlines, Air India. Yes or no? And that too also by shortest route. For example, 10,000 rupees LTA is given. And that LTA is given for your journey, which you are performing from Chennai to Jaipur, because you are going on a vacation to Jaipur. So what is the shortest route? Chennai to Jaipur. Direct route is there. Yes, direct flight is there. But there is one more flight. Chennai to Udaipur to Jaipur. Then there is one more flight. Chennai to Mumbai to Jaipur. Then there is one more flight. Chennai to Ahmedabad to Jaipur. Which is the shortest amongst all of them? Chennai to Jaipur. Shortest, no? So whatever is the economy class fare of this shortest route, of the Indian carrier, of this shortest route, to the extent of that amount, maximum your exemption can be there. Not more than that. So LTA received that amount or the amount actually spent. If these amounts are higher than this limit, no, so only this much will be exempt. Maximum. Getting my point? But if the LTA received is lower or the amount spent is lower than this limit, then whatever you are receiving or whatever you have spent, as the case may be, that will be exempt, and not this. This is the maximum limit. To this extent you can take the exemption. Getting my point? But this limit you will take only if the LTA you have received, and by taking that LTA you have performed the journey by air. But what if you have not performed the journey by air? Receiving the LTA, you are going on a vacation, but the journey is not performed by air. Then question number 2 will come. Then question number 2 will say that please say, are the places of your origin and destination, yes or no? Place where you are, from where you are leaving, and the place to which you are going, place of origin, place of destination. Places are connected by rail. See, we are not asking you whether you have performed your journey by rail or not. We are just asking you simple question. Are the places connected by rail? Does railway have connectivity? Chennai to Jaipur? Yes, obviously. Railway connectivity is there. First come to Mumbai and then from Mumbai catch the train. Or at least you can, from Chennai you can go to Bangalore, and from Bangalore also you can go to Jaipur. Hello sir. Places are connected by rail. So if the places are connected by rail, then first class AC fare of Indian Railways by shortest route, that is the maximum amount which to what extent you can take the exemption. See, journey you would have performed by any mode, we are not bothered. But the places should be connected by rail. So if the journey was performed by air, then economy class airfare. But if the journey is not performed by air and the places are connected by rail, then first class AC fare of the rail. Maximum to that extent you can get the exemption. Okay, and that first class AC fare should be of shortest route, not longest route, shortest route. Then if the answer to this is also no, then the next question. Okay, any recognized mode of transport is in existence or not? Meaning that if the place of origin and place of destination not connected by rail, so might be buses might be running over there. Hello? Maybe the buses might be running. Maybe any other specified mode of transport might be running there. So if any recognized mode of transport is also running, no, between the place of origin and place of destination, getting my point? Then the deluxe class also known as first class, yes or no? Deluxe class fare of such recognized mode of transport by shortest route. Maximum this much can be exempt. So if the journey is performed by air, then economy class airfare. If the journey is not performed by air, then second question, places are connected by rail? Yes. Then first class AC fare of Indian Railways. Hello sir. If the places are not connected by rail also, then journey not performed by air, and the places are also not connected by rail, then there is any recognized mode of transport running in that on that route? Yes or no? If the recognized mode of transport is there, then deluxe class AC fare. And what if that recognized mode of transport is also not there? No. Then my dear friends, it will be assumed as if journey is performed by what? Rail. And whatever will be the first class AC fare for this distance of Indian Railway will be there. That will be your maximum limit. So it will be assumed as if the journey is performed by rail, and first class AC fare of railway for such distance covered in the journey, maximum that much amount can be exempted. Will you remember this? Yes or no? Sure? Now pay attention. LTA or LTC. For journey performed to a place in, for journey of following individuals, place in India, employer, employees, spouse, children, dependent, brother, sister, parents. Then tell me, exemption under section 10(5) available or not available? Available or not available? Journey performed to a place in India for following individuals, and for them the LTA is given. LTA is given for journey performed in India for these persons. Exemption under section 10(5) given. How much exemption? A, B, C, whichever is lower. LTA amount spent on this journey for these people, hello, or maximum limit prescribed in rule 2BA. And the limits were, we have seen 4 questions. Yes or no? Either the limit will be this if the journey was performed by air. If the journey was not performed by air, but the places are connected by rail, then the limit will be this much. Yes or no? What if the journey is not performed by rail and the places are also not connected by rail? Then recognized mode of transport, deluxe class AC. What if recognized mode of transport is also not there? Then it will be assumed as if the journey is performed by rail, and whatever distance is covered, that is performed by rail. Yes or no? And for that distance, what is the first class AC fare of Indian Railways? Maximum that can be exempted. Will you remember? Sir, India is there, and for other relatives, come on, tell me what to do. Will you get any exemption? For a journey performed in India, LTA is given, but not for these persons. It is given for other relatives. It will be fully taxable. Exemption will not be available. Yes or no? Then what if the journey performed by these persons only? Okay. But the journey is performed to a place outside India. Then also the exemption is not available. Full LTA will be taxable. Sure? Now what if journey is performed outside India and for them the LTA was given, for that journey the LTA was given, and that journey was also performed by some other relative? Then also no exemption will be available. It will be fully taxable. Will you remember when the exemption will come? Sure, sir? Okay, perfect. Pay attention now. Exemption under section 10(5) shall be available for LTA which is received for. LTA received for, come on, tell me. Employee himself? Possible? Yes. Employees? Spouse possible? Yes. Children? Possible, no? And dependent? Brother, sister and parents. For all of them it is possible. But when it comes to children, no? So LTA is given for employees' children. Employee has 4 children. All the 4 children are going, and for all the LTA is given. Can the LTA for all the 4 children be exempted? Employer is giving LTA for all the 4 children. Your 4 children are there, no? Take the LTA for all the 4 children. Employer can give you the LTA for all your children. But will you get the exemption of LTA of all your children? Or there is any limit? There is no limit if the children are born prior to 1st October 99. So if the children for whom the LTA is given, if all the children are born prior to 1/10/98, for all the children LTA can be exempted. Hello? But what if the children are born on or after 1/10/98? If the children are born on or after 1/10/98, for such children, if the LTA is given, that LTA can be exempted for maximum 2 such children. Hello, sir. So I'm talking about the children now. Employees' children. If born prior to 1/10/1998, then for all such children, LTA given by employer can be what? Exempt. For all the children. If you have 50 children who were born prior to 1/10/98, for all the children you are getting LTA, take the exemption for all the children. Go. Because all the children were born prior to 1/10/98. But in 1/10/98, on 1/10/98, 98 was election year. Hello. And in that year, amendment came, and that amendment got effective from 1/10/98 onwards. Hello, sir. So they brought an amendment with retrospective effect, no, from prospective effect. From now onwards, whatever kids will be born, no, 1/10/98 or after that, whatever kids will be born, LTA for such children received from the employer can be exempted for maximum 2 of such children which are born on or after 1/10/98. Getting my point? So if children are born on or after 110 1998, children born on or after 110 98, for any two of such children, LTA given by employer can be exempt, and for remaining children, LTA given by employer will be fully taxable. Will you remember? So for you, can you take the exemption? Yes. For your spouse, LTA was given. Can you take the exemption? Yes. You have three children. All the three children born prior to 11098. For all of them, LTA is given. Can you take the exemption for all the three children? Yes, because all the children were born prior to 11098. Hello. But what if these three children were born on or after 11098? Then out of these three, LTA for one child will be fully taxable. Any two child LTA, you can take the exemption. Hello, sir. But what if out of these three child, one child was born prior to 98 and two children born on or after 11098? Then also for all the three, you can claim the exemption. On or after 11098, how many children are there? Two only, no? So for both of them, you can take the exemption. And the children who were born prior to 11098, for all of them, you can take the exemption. Got it, sir? But what if I have three children? I'll put you in some trouble now. Give me the answer, huh? I have three children. All the three are girls. One is Sita, second one is Geeta, and third one is Babita. I have three girls, three children. Sita is 8 years old right now. Geeta is 6 years old right now. And Babita is 3 years old only. Getting my point? So right now, if there is ages 8, 6 and 3, that means all these three children are born on or after 11098 only, no? Only then today they are 8, 6 and 3 years old. So they are born on or after 11098. Now for these three children, I am getting LTA from the employer. Tell me, can I take the exemption for all these three children? The answer is no. Any two out of these children which are born on or after 11098. Hello, sir. Got it, sir? Now please pay attention. What if Geeta and Babita both are 6 years old? Meaning that they are twins. So after one child, whatever multiple births are there, no, they will be treated as a single child only. After one child, huh? After one child. So if I already have a child, I was planning for the second, but God gave me two. Should I send back one? No, I will keep both of them, no? So I already have one child. After the one child, I am having multiple births in the form of twins, triplets, etc. So all those children born in that multiple births will be treated as single child only if they are born after the single child. Yes or no? So in this case, for all the three children, I can take the exemption because twins born after first child will be treated as single child only. But what if this could have been the situation, no? Sita, Geeta both are twins. And then Babita happened. Hello? Now, if I already had twins, hello? Then how many kids I have? I have two, no? If I already had twins, I have two. Third one I planned and I got the third one. Hello, sir. So my intention was to have the third child because I was already having two children prior to this. So two children already I am having, both are twins. But after that, the birth is happening, that is a third birth. Hello. So 1, 2 and 3. Out of these three, any two. I cannot count this multiple birth as single child. Hello, sir. After single child multiple birth happens, no, only that will be treated as what? Only that will be treated as single. After single child, multiple births will happen. That will only be treated as single child. Got it? No, 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 no. This logic applies here only. Don't apply this logic everywhere else. This is for this thing only. So if for children education allowance, you're not supposed to put this logic. Twins, triplets, whatever it is, they are separate children. Got it? Okay. Now pay attention. Did you understand this much? Now one more simple thing. See, there is one block of 4 calendar years. And this block they have started with effect from 1986 onwards. So 4 calendar years will be in one block. And they've started making such blocks since 1986. So the first block of 4 calendar years was 86, 87, 88 and 89. Then the second block of 4 calendar years was 90, 91, 92 and 93. Then the third block was 94, 95, 96, 97. Then 98, 99, 2000, 2001. Then 2002, 2003, 2004, 2005. Likewise, 4 calendar years, one block is there. So in one block of 4 calendar years, in one block of 4 calendar years, maximum 2 exempt journeys can be performed. Maximum 2 exempt journeys can be performed in one block of 4 calendar years. This is the requirement of 10 subsection 5. So right now, currently the block which is going on, no, that is 22, 23, 24, 25. This block is currently going on. Prior to this, there was one more block. 19, 20, 21, sorry, 18, 19, 20, 21. Prior to this, there was one block, 18, 19, 20 and 21. Then this block has started, 22, 23, 24, 25. After this, one more block will start, 26, 27, 28 and 29. So this is the following block. This is the existing block and this is the previous block. Yes or no? Likewise, 4 calendar year blocks, they have started making such blocks since 1986. And they are saying that in one block, meaning if we talk about this block will start from 1st of January 2022 and it will end on 31st December 2025. Within this period of 4 calendar years, how many LTAs your employer can give you? Your employer can give you n number of LTAs. By taking those LTAs, you can perform the journeys also. But out of those journeys, maximum 2 journeys in this block can be claimed as exempt. Take LTA, perform the journey, take the exemption once. Then take LTA, perform the journey, take the exemption twice, second time. In this block, only 2 times this can happen. Now, whatever LTA you are receiving, whatever journey you are performing, for that, now you will not be getting any exemption. Why? Because in this one block of 4 calendar years, maximum 2 journeys allowing you to take the exemption can be performed. Getting my point? Hello, sir. Now wait, wait. What if out of two journeys, only one journey you can perform and take the exemption? Then the second journey which you could not perform to take the exemption, second exemption journey which you could not perform, don't worry, that will be carried over to the next block. So next block, two journeys are already there. One more journey will come, carry over. But remember that journey has to be performed in the first calendar year of that block. Otherwise that journey will lapse. Sir, what if I don't perform both the journeys in this block? I was getting two journeys, I was getting LTA, and by performing the journey, I was able to take exemption twice. No, so I could not take the exemption both the times, because either I did not perform the journey or I forgot to take the exemption. Possible or not? So both the journeys which you could not perform in this block, out of that one journey will be carried over. If one cannot be performed, one can be carried forward. If both cannot be performed, one can be carried forward. Yes or no? But the journey which is carried over has to be performed in first calendar year of the next block. Otherwise that will also lapse. So in the next block, first calendar year will come. In that first calendar year, take the LTA and perform that journey. Perform journey out of that LTA to claim the exemption. And now you have two more journeys to perform in this block, because one was carried over which you have already performed in the first year. Got it, sir? LTA is done. Now for LTA, there is question. Come on, let's see LTA. Question number 11 and question number 12. Two questions are there. 11 is also there, 12 is also there. Mr. D went on a holiday on 25th of December 2024 to Delhi with his wife and three children. One son, age 5 years, twin daughters, age 3 years. Can I say after one child, twins are born? All the children are born on or after 1/10/98. So after one child, whatever twins are there, they will be treated as a single child only. Yes or no? Now, they went by flight, economy class, and the total cost of tickets reimbursed by his employer was 60,000 for all of them. Meaning 45,000 for adults, meaning Mr. D and his wife, 45,000 was reimbursed as LTA, and 15,000 for three children, meaning 5,000 each. Compute the amount of LTC exempt if Mr. D exercises the option of shifting out of the default tax regime. Meaning that if he will shift out of default tax regime, he is going to get the exemption. So LTA exemption will be available only if you shift out of 115 BSE. What if you don't shift out of 115 BSE? You follow 115 BSE. Then the LTA exemption will not be available. That will be fully taxable. Hello, sir. Everyone. So pay attention. How much LTA received? If the assessee is not following 115 BSE, shifting out, then LTA received was 60,000. Now out of this LTA, some LTA will be exempt under section 10(5). How much will be exempt? A, actual LTA, B, actual amount spent, C is maximum limit in rule 2BA. Now tell me one thing. How much is the actual LTA? It is 60,000 only. 60,000. And 60,000 LTA is given towards the actual reimbursement, meaning the actual amount spent is also 60,000. So actual amount spent is 60,000. And they have spent equal to the economy class airfare only. So what was the economy class airfare? Journey is performed by air. So for that journey, maximum limit is economy class airfare, and that economy class airfare only which they have spent. Hello. And which they are getting as what? LTA. So economy class airfare is also 60. So economy class airfare was 60 only, maximum limit, which they spent. Actual spending is 60 only, and which they got as LTA also. So amount received as LTA, every amount is 60 only. But these amounts can be different, huh? In this question, luckily all the amounts are same. Now tell me, whichever is lower. So how much will be the exemption? 60. And how much will be taxable LTA? Nil. What if they would have told you that the assessee is following 115 BSc? Then no need to take this exemption, entire LTA taxable. That's it. Sure? 11th question understood, everyone? Come to 12th one. In the above illustration 11, will there be any difference if among his 3 children the twins were 5 years old and the son 3 years old? Discuss. Yes, absolutely. This entire thing would change now. Actual LTA for all of them was 60,000. So either the actual LTA, see 60,000 LTA was there, no? So I will write down for father, mother and 2 children LTA, and for children in excess of what? In excess of 2 children. See, for father, mother it is 45, and for all the 3 children it is 15. So I am supposed to take only for 2 children. So for father, mother 45, and for 2 children 10,000. So it was 55,000. For one child, LTA was 5,000. That I am going to write here. Hello? No exemption from here. What did I say? No exemption from here. This will be fully taxable, 5,000. Done. But what about this side? 55,000 spent, 55,000 actual amount, and 55,000 was the limit. Whichever is lower, 55,000, this will be exempt. How much will be taxable? Nil. And for the third child, whatever 5,000 you are getting, that will be fully taxable. Got it? Easy? Should I move ahead? Very good. Now let's discuss those questions which I gave yesterday. Okay. So first of all, we'll discuss those questions now. Come on. Which question I gave first? 21 if I'm not wrong. Yes or no? 21. Please check. First question which I gave for homework was question number 21, no? Shall we start? Come on. Shri Bala, employed in ABC Company Limited as a finance manager, gives you the list of perquisite provided by the company to him for the entire financial year. Domestic servant was provided. Servant was provided. Meaning this is clause 3 perquisite. At his residence, salary of domestic servant is 1500 per month. The servant was engaged by him and the salary is reimbursed by the company. Okay, if now they are saying that domestic servant provided at home, but that domestic servant was not engaged by the employer and provided. They are saying that it was engaged by him only. Understanding? So if it was the servant was engaged by him only and the salary for that servant was given by the employer, then it is a perquisite. But it is not clause 3 now, because the domestic servant facility provided. But that domestic servant was not engaged by the employer. It was engaged by the employee himself. So employee's liability, employee's obligation met by employer, clause 3 or clause 4? Clause 4 perquisite. So here it will be 17 subsection 2, clause 4 perquisite, and as per this clause, whatever salary paid by the employer for that domestic servant will be his benefit, fully taxable for him. Getting my point? But wait, even if he is a specified employee or a non-specified employee, that 18,000 will be fully taxable for him. Sure? What if in case the company has employed the domestic servant? What is the value of perquisite? Then also the value of perquisite will be same. But now the perquisite will be as per 17 to 3, 18,000 will be taxable. And this 18,000 will be taxable in his hands, assuming that he is a specified employee. Hello, sir. But what if he was a non-specified employee? Then under clause 3, this 18,000 is not taxable for him. So whether you follow clause 3, then also this 18,000 is taxable. Whether you follow clause 4, then also this 18,000 is taxable. But the difference is clause 4 will come if the servant was engaged by you. Whether you are a specified employee or a non-specified employee, that 18,000 is taxable for you. Clause 3 will come. 18,000 is taxable as per clause 3. But this will come taxable only if you are a specified employee. Getting my point? Is the question mentioning that Bala is a specified employee or a non-specified employee? Mentioned anywhere? So meaning we will consider as if he is a specified employee only. So whether clause 4 or clause 3, the taxable value of this perquisite will remain 18,000 only. Yes or no? Okay. Now free education was provided to his two children, Aarti and Ashok, in a school maintained and owned by the employer. An educational institution which is owned and maintained by the employer, in that school, if the children of the employee are studying, and the amount spent by the employer on that educational facility will not be benefit. The reasonable cost of education will be the benefit. Yes or no? But if that reasonable cost of education for one child happens to be 1,000 per month or less, then it will be exempt. But if it is more than 1,000, hello, then two possibilities. Entire amount can be taxed, or amount in excess of 1,000 can also be taxed. Did I tell you this? That same point is here. Come. The cost of such education for Aarti is computed at 900 per month. Wait, this is not the amount actually spent by the employer. This is the computed amount, meaning they are telling the reasonable cost only. And for Ashok, it is 1,200 per month. So the amount which was computed for Ashok was 1,200, which is more than 1,000. So 1,200 will be fully taxable, or maximum, or 200 can also be taxed for Ashok, and for Aarti nothing will be taxed. Why? Because for her the cost of education is computed at only 900 per month, which is less than 1,000. Got it? So here how much will be taxable? Come on, tell me. For Aarti nothing will be taxable, and for the educational facility given to Ashok, 1,200 into 12 will be 14,400. That will be taxable. Got it, sir? Everyone, sir? Should I move ahead? Okay. Now, no amount was recovered by the company for such educational facility from Bala. If amount was recovered, I would have reduced that amount out of the taxable amount. If nothing is recovered, then entire amount is taxable. Got it, no? Next one. The employer has provided movable assets such as television, refrigerator, and air conditioner at the residence of Bala. Provided at the residence of Bala so that he can use, not sold him. So can I say this is the use of movable asset facility? And the actual cost of such assets is 1,10,000. So can I say 1,10,000 into 10% per annum, assuming that the assets were used for the full year. So the amount will be how much? Taxable amount will be 11,000. 11,000 you got? Everyone? Next one. Gift voucher worth 10,000. On the occasion of marriage? No, read further. Marriage anniversary. Not on marriage. Marriage anniversary. So gifts on marriage is not taxable, but the gifts received on marriage anniversary are taxable. And if they are provided by employer, will be taxable under the head salary. Getting my point? Provided by others, then other sources. But if it is provided by the employer, then it will be taxable under the head salary only. Now, is the entire amount 5,000 or less? No, the entire amount is more than 5,000. Then the full amount can also be taxed and excess can also be taxed. How much you will tax? Full amount will tax full amount 10,000. Done or no? Okay. The telephone provided at residence of Sri Bala and bill aggregating to 25,000 paid by the employer. Yesterday, we did one facility. All the notified perquisites benefit under clause 8. Interest benefit was there, credit card facility was there, club facility was there, gift was there. Last point was there. Any other benefit, amenity, facility, yes or no? Even that is treated as perquisite in the hands of employee. So this is any other benefit. But it is very difficult to identify that out of this perquisite, how much is personal and how much is official. Hello, sir. So whenever the telephone facility is provided, mobile bills are paid by employer, mobile or telephone bills are paid or reimbursed by the employer, telephone facility given by the employer, such type of benefit is fully exempt. Getting my point? Hello, sir. Kaushik, is it visible now? Nothing is visible. Since when? Right now only it has happened? Or since the beginning only? So there might be some network issues. Wait, let me check. Okay. Now is it okay? Please check. Connection is unstable. So let me continue a little bit. Maybe the network will get. But are you able to listen to me properly? And seeing that same thing in your textbook also? Perfect. Getting everything, no? Okay. Pay attention. So whatever telephone facility is provided, telephone bills paid by the employer, mobile bills paid by the employer, or it is reimbursed, that is a perquisite. Perquisite coming under clause 8 only. But since it is very difficult to identify that how much will be the personal benefit out of this perquisite or how much will be official, because telephone use is for both official and personal. Getting my point? So in order to avoid further problems between the assessee and department, what the law says that this benefit given will be fully exempt. But if the telephone allowance would have been given, that would have been fully taxable. Yes or no? But telephone allowance is not given. Telephone facility. telephone bills are paid by employer, telephone bills are reimbursed, mobile bills are paid or reimbursed, then it will be a facility fully exempt. So how much will be taxable here? Nil. This 25,000 will be fully exempt. Getting my point? Next one, housing loan 6% per annum. Now for this, you'll have to make the calculation. What calculation you'll have to make? Every month end, what is the outstanding balance of loan? On that interest benefit you'll have to calculate, because the loan was 6 lakh and every month 12,000 rupees principal is repaid 5th of each month. So can I say on 30th April 6 lakh will not be outstanding. 6 lakh minus 12,000, 5 lakh 88,000 will be outstanding. Yes or no? Then next month again 12,000 will be repaid. So every month the loan amount will keep on changing. So every month, see, the last day the loan amount outstanding will be this much. Done? And how much is the interest benefit? See, the employer is charging 6%. And what is the SBI's prime lending rate? They have given the lending rate of State Bank of India is 10%. So reasonable rate is 10%. Employer is charging how much? 6%. 4% benefit is there. So for every month, 4% will be benefit into 1 by 12. Yes or no? Into 4% into 1 by 12. Into 4% into 1 by 12. You will get all these benefits every month. So now if you total, you will get 20,880. Getting my point? So can I say here the taxable value of this perquisite will be 20,880? Now please, on your calculator, take 18,000 taxable value of domestic servant facility, 18,000. Then take educational facility, 14,400 on your calculator. Then add 11,000. Use of movable asset, yes or no? Add 10,000 gift. Then add 20,880. What is the final amount? On your calculator, you must get 74,280. Are you all getting it? This is the taxable value of all the perquisites which he is receiving from his employer. So this amount will now be taxable under the head salary. Got it? Everyone? So 21 done. Then I gave you 23 also, if I'm not wrong. Sure. I'll discuss 23. Come on. X Limited provides the following perquisites to its employee, Mr. Y. Accommodation taken on lease by X Limited for 15,000 per month, rupees 5,000 per month is recovered from the salary of Mr. Y. This is accommodation facility. Do you remember accommodation? Hello, sir. What was the accommodation facility? Did I tell you that accommodation is given to the employee who is a government employee? Then the licensing fees will be taxable. But if it is given to a non-government employee and the accommodation was owned by the employer, then you have to see the population of the place where the accommodation was given. Based on the population, 10%, 7.5% or 5% of salary will be taxable. But if the accommodation was taken on rent by the employer and provided to you, then for that accommodation 10% of your salary or actual rent paid by the employer, whichever is lower, that will be your benefit. Yes or no? So here they are saying that the accommodation is taken on lease by X Limited means that the accommodation was taken on rent by the employer. And that accommodation, how much rent was paid? 15,000 per month. That was given to you. So for this, 10% of your salary needs to be calculated. Or 15,000 into 12, 1,80,000. So 1,80,000 or 10% of your salary, whichever is lower. That will be your benefit. But wait. First you'll have to calculate the salary. And in salary you are taking everything other than those 5 things. Do you remember? DA not in terms, employer's contribution to provident fund. Then third one was value of all other benefits. Fourth one was the exempt portion of allowance. Fifth one was lump sum retirement or retirement benefits. Ignore all these 5 things. Take all the salary on due basis from all the employer. And this salary must become due for the period for which the accommodation was occupied. Do you remember this thing? But wait, this we are going to calculate in the end only. Till the time I will not solve the entire question, I will not be able to find out that salary. So let's come to this part, first part, later on in the end. Okay. So first let's complete everything else. But we know that how much amount should be taxable here. How to calculate that we are going to calculate later on. But how much will be taxable that we know. 10% of salary or actual rent paid by the employer, 1,80,000, whichever is lower. But 10% of salary will be calculated in the end. So the value of this perquisite will be calculated at the end. Got it? So pay attention now. Furniture for which the hire charges paid by X Limited is 3,000 per month. No amount is recovered from the employee in respect of the same. 3,000 per month into 12. So this furniture which was given, the rent paid by the employer was 3,000. If he would not have paid this rent, you would have paid. So are you paying? No, employer is paying this rent. So you are saving this rent. This is your benefit. So 36,000 will be for use of this furniture. This 36,000 will be taxable for you. Done. Next one. A car of 1200 cc which is owned by company, owned by employer, given to employee to be used both for official and personal purpose. Can I say partly official, partly personal? Now for this car, see, all the running and maintenance expenses are fully met by employer, and he is also provided with a chauffeur, meaning that he is having two benefits now: use of car belonging to the employer and expenses also met by the employer including driver's salary. Both the benefits taxable minus the recovery. Fully taxable if the car was used fully personal. But this car is used partly official, partly personal. So this benefit need not be calculated. A fixed amount is taxable. And that fixed amount will be 1,800 or 2,400 depending on the engine capacity. Plus 900 extra you will have to do because the driver salary is also paid by the employer. Hello sir. So how much will be taxable? 1,800 because the engine capacity was less than 1,600 cc plus 900 also. Meaning that 2,700 per month into 12. So can I say this will be 1,800 per month plus 900 per month multiplied by 12 months. How much you will get? 32,400. Everyone got this? A gift voucher of 10,000, meaning that entire 10,000 will be taxable. Compute the value of perquisite chargeable to tax for the assessment year 25-26, assuming his salary for perquisite valuation to be 10 lakhs. See how good this examiner is. He is telling you that for the purpose of valuing the perquisite of accommodation, his salary has to be taken as 10 lakhs. So 10% of 10 lakhs will be 1 lakh. Either 1 lakh or 1,80,000, whichever is lower. So that 1 lakh will be his benefit. And but out of that, the employer is recovering something. How much recovering? 40,000. Sorry, 60,000. 5,000 per month is recovered. No, 5,000 into 12 will be 60,000. So here it will be 10% of 10 lakhs, which is equal to 1 lakh, or 15,000 per month into 12 months, which is equal to 1.8 lakh. So 1 lakh or 1.8 lakh, whichever is lower, 1 lakh will be the benefit. And out of that 1 lakh, 60,000 is recovered. So how much benefit? Only 40,000. Got it? Now can you add all these figures? You will get 1,18,400. Everyone should get this answer. Value of perquisite chargeable to tax will be this much. Are you getting 1,18,400? Please check the total. Bro. Done. Easy question, no? This type of question will not come in the exam. All these perquisites will be forming part of salary chapter, salary head. So when you will be calculating the salary income, no, all these perquisites will be there. So take these values in the salary statement along with basic, allowances, what do I say, basic, allowances, commission, bonus, and these amounts will also come in the salary statement. Then your total salary will come. From that you are going to take the deduction and the final income will come. All these cannot come. Any one of them can come, or these will come and few more will come. It can be anything. Done, no? Okay, so this was your question number 23. So 21, 22, 23 all done. Now coming to test your knowledge. Test your knowledge. Question number 1 we did. Question number 2 I gave you as a homework yesterday, no? Let's discuss that also. Question number 2. Not given as a homework. Medical facility. One similar type of question we have done today. Medical facility. Do you remember? Let's do this question. Come on, fast. Question number 2. Miss Rakhi is an employee in a private company. She received the following medical benefits from the company during the previous year 24-25. In the end, examine the taxability of above benefits and allowances in the hands of Rakhi. So meaning she is given 6 benefits and allowances. You are supposed to say that whether they are taxable or not. If taxable, then how much? If not taxable, then why not taxable? Yes or no? You are supposed to say that. So reimbursement of the following medical expenses incurred by Ms. Rakhi on treatment of her self-employed daughter in a private clinic. Self-employed daughter, meaning the daughter is not dependent on her. See, spouse or children may or may not be dependent. For them, if the medical facility is received, can be exempt, provided the treatment is done in India in GRE. So the benefit is given for child, but the benefit is given for the treatment happening in India in GRE. Are they mentioning this? No, the treatment is done in a private clinic. If the treatment would have been done in GRE, then this benefit would have been exempt. But since the treatment is not done in GRE, the benefit cannot be exempt. It will be taxable. Hello? So 4,000 tick mark, taxable. Then on treatment of herself by family doctor. Ayyo. Again the treatment is done in India. But who is doing the treatment? Treatment is happening in GRE? No, treatment is happening by family doctor. Then also it will be fully taxable. Tick mark. Next one, treatment of her mother-in-law. Mother-in-law cannot be a specified patient only. So even if the treatment is done in GRE, still it will not be exempt. Furthermore, the treatment is not happening in GRE also. So one, the patient is also not a specified patient and the treatment is also not happening in GRE. Then this benefit cannot be exempt. This will be fully taxable. Yes or no? So how much will be the medical facility taxable for her? 4,000 plus 8,000 plus 5,000. Yes or no? This will be fully taxable for her. Next one, payment of premium on Mediclaim policy taken on her health. So whatever medical insurance policy premium for yourself the employer is paying, that is a fully exempt perquisite for you. Nothing taxable. Cross mark. Medical allowance given, that will be fully taxable, huh? Because a fixed amount is given on a regular basis to meet your medical expenses. That will be taxable because that may or may not be used for treatment, etc. Hello? And if I would have been your examiner, in the bracket I would have given out of this medical allowance, rupees 1800 per month is spent. Underline. Bullshit. Why? Because this medical allowance is fully taxable. Out of this, whatever you are spending, on the basis of that, you are not going to get any exemption or deduction. That is just given to confuse you. Getting my point? This will be fully taxable. Will you remember? So this 24,000 will be taxable over here. First one is 12 plus 5. 17,000 taxable here. There will be nothing taxable here. There will be 24,000 taxable over here. Hello, sir. And medical expenses reimbursed on her son's treatment in a government hospital. Thank God, now the treatment is happening in India for a specified patient also, and the treatment is also happening in government hospital, GRE. Then the benefit will be fully exempt. Nothing will be taxable here. Nil. Next, expenses incurred by company on treatment of her minor son abroad, including stay expenses. So treatment is happening outside India. Treatment cost as well as stay cost of the specified patient is incurred by the employer. This will be exempt. Cost of treatment, cost of stay will be exempt to the extent of RBI limit. Hello, sir. RBI limit given. See note. Limit prescribed by RBI for expenditure on medical treatment and stay abroad is US dollar 2,50,000 per financial year under liberalized remittance scheme. Meaning $2,50,000. Even if you multiply it by today's rate, the amount will be in lakhs. So the limit for spending is in lakhs. RBI limit is in lakhs. Your employer is giving you the benefit within the limit only, no? 1,05,000 only. That 1,05,000 is very less as compared to the limit, if you see. So within the limit, within the RBI limit only you are getting the benefit. That benefit will be fully exempt. Nothing will be taxable here also. Nil. Got it, friends? Next one. Expenses in relation to foreign travel of Rakhi and her son for medical treatment. Either this will be fully exempt or this will be fully taxable. Treatment done outside India, cost of stay, cost of treatment, exempted as per RBI limits for patient. But for one attendant and patient and one attendant, cost of travel can be fully exempt also, can be fully taxable depending on the GTI. So if Rakhi's GTI happens to be 2 lakh or less, then this 1,20,000 will be fully exempt. If her GTI happens to be more than 2 lakhs, then this 1,20,000 will be fully taxable. So what to be done? They have not told us anything. They are just saying examine the taxability. We are examining only. We will write down that if Rakhi's GTI happens to be more than 2 lakhs, then this 1,20,000 will be fully taxable. If Rakhi's GTI happens to be less than or equal to 2 lakh, then this 1,20,000 will be fully exempt. That you are just going to write. Getting my point, everyone? Understood? So this was your question. Have you solved this question at home today? Yesterday you have solved? You got all the answers like this only? Or you got stuck somewhere? Medical facility was not taught. So today it is done. Yes or no? Come on. Now let's come to this one, this question. Please pay attention. Now you are going to calculate income from salary. So should I solve? Everyone? Even this was your homework, no? Let's see. X is employed with AB Limited on a monthly salary of 25,000 per month. Did you see something? Did you notice something? Meaning this is monthly amount, no? Then why are you writing per month? Either write down 25,000 per month or write down monthly salary 25,000. We will understand, no? See, monthly salary of 25,000 per month. Thank God you told us it is per month. Otherwise, we were not going to understand only. Yo, monthly salary of 25,000 meaning 25, 25, 25, hello. Or if they are saying 25,000 per month means monthly salary only. They are writing both the things. Monthly salary of 25,000 per month. Wow, very good. Smart people there. Come on, let's see. Entertainment allowance and commission of 1,000 per month each. Wow, 1,000 per month. Entertainment allowance, 1,000 per month. What? Commission also. So first of all, can I say 25,000 into 12 will be her basic salary? So 25,000 into 12 will be 3 lakh. So her basic salary taxable will be 3 lakh. I'll just write down the taxable amounts. Okay, no? Then 12,000 entertainment allowance will also be taxable for her. And 12,000 commission will also be taxable for her. But wait, if she is receiving entertainment allowance, which is getting taxed, but for that entertainment allowance, will she get any deduction under 16 clause 2? But for that, we'll have to first see that whether she is following 115 BSE or not. So they are saying shifting out of the default tax regime, meaning she is not following 115 BSE, meaning that she is eligible to get exemption. but that exemption is available, sorry, she is eligible to claim deduction. But that deduction for entertainment allowance will be available only if you are a government employee, no? You are not a government employee, hello. You are the employee of AB Limited, non-government employee. So non-government employee, only entertainment allowance will be taxable, but 16 clause 2 deduction will not be available. Why? 115 BSE is not followed. You could have got, but you are not a government employee. That's why you are not getting it. But if you would have been a government employee, you would have definitely got this deduction also. Because you are not following 115 BSE. Getting my point? Should I move ahead? Commission is fully taxable. And this commission, my dear friends, is it a turnover commission or a fixed commission? Nothing given, sir. So we'll have to assume. I'll give you a tight slap if you'll assume. Per month means fixed amount on a regular basis. This is a fixed commission. This is not a turnover commission. Getting my point? Hello? Fixed or turnover, what difference will it make? It is going to tax only, no? But sometimes you have to take, in calculation, you have to take turnover commission also. That time you are not going to take this commission because this is not turnover, this is fixed commission. Getting my point? Next one. A company owned accommodation is provided to him in Delhi. Okay. Company owned accommodation. Meaning a non-government employee getting accommodation which was owned by the company in a place called Delhi, which has the population of more than 40 lakhs. So we know that from this she'll get a benefit of 10% of salary. But wait, salary will be calculated at the end. So the value of this benefit will be calculated at the end. Yes or no? We just have to take 10% of salary. That is the taxable value. Got it? Next one. Furniture costing 2,40,000 was also provided on 1st of August 2024 along with this accommodation. So we will not just calculate this amount. Along with that we will add what? 2,40,000 into 10% per annum of the actual cost of the furniture. Yes or no? And then in that we will do from August the furniture is given, no? So April, May, June, July, 4 months you forget into 8 upon 12. So this will be the furniture value. Accommodation has to be calculated. Both added will get the taxable value of this perquisite. Yes or no? But this will happen in the end. Okay. Should I move ahead? Next one. A personal loan of rupees 5 lakhs on 1st July 2024 on which company charges interest 6.75% per annum. The entire loan is still outstanding. Assume SBI rate of interest is 12.75. Can I say concessional interest, concessional loan provided by the employer? 5 lakh. And wait, this 5 lakh will be outstanding for all the months. Because repayment is not happening monthly. Repayment will happen after a year. So every month of the previous year, starting from July. Why? Because loan only is taken in July. There was no loan taken in April, May, June. For 3 months, there is no loan. So no interest benefit. Interest benefit will arise the moment you take the loan, no? From July only. And July month, how much is outstanding as on the last day of July? 5 lakh. On that, how much is the benefit? 6%. 12.75 minus 6.75. Hello? Into 1 by 12. And that same calculation you are going to do 9 times. Or for 9 months together. Do it for 9 months together. So what are you going to do? 5 lakhs into 12.75 minus 6.75% into 9 upon 12. Please don't commit these kind of silly errors in calculations. Okay. Now tell me. 5 lakh into 6% into 9 divided by 12 will give you 22,500 taxable value of this perquisite. So the taxable value of this perquisite will be 22,500. So along with basic, along with entertainment allowance, along with commission, this amount will also be taxable under the salary head. Yes or no? One more amount is taxable that we are going to calculate. And then we are going to write here. Fill in the blanks. Done? Next one. His son is allowed to use a motorcycle belonging to the company The company had purchased this motorcycle for 60,000 on 1st May 2021. The motorcycle was finally sold to him on 1st August 2024 for 30,000. This is a beautiful adjustment. Mark this adjustment important, because here two benefits are there. One, use of movable asset benefit is also there, and that movable asset which was already used by you, already under use by you, that is during this year sold also to you. Getting my point? See, I will draw a small timeline so that you understand. Okay. Motorcycle was acquired by the company on 1/5/2021. So on 1/5/2021, the motorcycle was purchased and the actual cost of that motor car was 60,000 to the employer. Now employer gave this motorcycle to the employee so that his son can use. Let's say from that same day it was given for use. So from that day only it is used by the employer in his business. How come used by employer, sir? Employer has given this motorcycle to his employees for use, meaning the employer is using in business to give to the employee. Yes or no? Now this is used by the employee. Tell me, as on 1st April 2024, meaning first day of our previous year, this motorcycle is still used by the employee's son. So from 1st April of my previous year, there will be use of motorcycle benefit accruing to the employee. So April, May, June, likewise till 1st August. Meaning that on 1st August 24, the same motorcycle was sold to the employee. So on 1st August 2024, sold to employee for how much? 30,000. Getting my point? Now here there is one benefit and one more benefit is there. For this period, it is a benefit by using the motorcycle. So here also there is one benefit. Here it is use of movable asset. Hello? And that use is for how many months? April to July. 4 months. So what is the actual cost? 60,000. Actual cost into 10% per annum is the benefit, no? By using. So 60,000 into 10% into 4/12, because use is only 4 months. So 60,000 into 10% into 4 upon 60,000 into 10% into 4 divided by 12 will give you 2,000. This 2,000 will be taxable value of perquisite by using the motorcycle. Now this motorcycle was sold on what date? 1st August 2024. Can I say till 1st August 24 it was used by the employee, meaning it was used by the employer in his business, given to the employee, yes or no? So starting from 1st May 2021, can I say 1st May 21 to 30th April 22, it was used in the business of the employer because it was given to employee for using it, yes or no? Then from 1st May 2022 to 30th April 23, this second year also it was used in the business of the employer because for this period also it was given to employee for using it. Then from 1st May 2023 to 30th April 24, third year also it was used in the business of the employer. And my dear friends, 1st May 24 to 30th April 25, fourth year it could not be used for the full year because between these two dates, on 1st August 2024, it was sold to employee for how much? 30,000. Getting my point? So now what I will do? I will take the actual cost. I will take the actual cost, which was 60,000. Now from that actual cost, I will reduce the depreciation for 3 completed year of use. 1, 2 and 3. For the 4th year or the fraction of that year, I will not take any wear and tear. Getting my point? So now wear and tear will be at what rate? 20% WDV, 50% WDV or 10% SLM? It will be 10% SLM. Why? Because the asset sold, movable asset sold is not computer, laptop or electronic gadget, and it is neither motor car, it is motorcycle. So it will be eligible for 10% wear and tear on SLM basis. So first year 10% of 60,000 will be 6,000. Second year also 6,000 and third year also 6,000. So 18,000 I will reduce and I will get 42,000 value. Can I say the value of 42,000? Motorcycle has a value of 42,000. That motorcycle was given or sold to the employee for only 30,000. There is a benefit of 12,000. Got it? So please pay attention. Here by use benefit is 2,000 and transfer or sale of movable asset, the benefit is 12,000. How did we calculate these two amounts? Did you understand? So both these amounts will be taxable under the head salary. Everyone, this is also taxable. This is also taxable as salary. Yes or no? Professional tax paid by Mr. X is 2,000. For that, he will get deduction under 16 clause 3. Done. Because he is also following, he is shifting out of 115 BSc. If he is not shifting out, then this 16 clause 3 will not be allowed. Getting my point? Hello? Now tell me, did you get all the taxable amounts? Now in your salary, these yellow colored amounts are taxable. Salary statement. Out of these amounts, which amounts will be treated as salary for the purpose of valuing the perquisite? 3 lakh will be taken as salary because it is a basic salary. On your calculator, take 3 lakhs. Take 3 lakhs. 12,000 rupees was entertainment allowance. This is not exempt allowance. This is taxable allowance. Taxable allowance we are supposed to take. And commission also we are supposed to take. So 3 lakh plus 12,000 plus 12,000. We are not going to take the value of other perquisites. So 22,500 is the value of other perquisite. 2,000 or 12,000 is also the value of other perquisites. We are not going to take those benefits. So on your calculator, are you having 3,24,000 of salary? And on the basis of this 3,24,000 of salary, the accommodation facility will be valued. 3,24,000 into 10%. Did you get this? So 10% of 3,24,000 will be 32,400 and plus 2,40,000 into 10% into 8 divided by 12. For furniture, it is 16,000. 16,000 plus 32,400 will give you 48,400. And my dear friends, this 48,400 is rent-free furnished accommodation. Accommodation value is 32,400 and furniture value 16,000. Both taken together, 48,400 will be the taxable value of accommodation facility. Understanding? On your calculators now, please. 3 lakh plus 12,000 plus 12,000 plus 48,400 plus 22,500 plus 2,000 plus 12,000. Tell me the gross taxable salary now. 4,08,900. 4,08,900. This is the gross taxable salary. And out of that, are you going to get any deduction? Yes, standard deduction you are going to get only 50 because you are not following 115 BSc. And 16 clause 3, 2,000 will also be allowed, no? So you are going to get the total deduction of 50,000 standard deduction and 2,000 professional tax. Please total. So 4,08,900 minus 52,000, you are going to get 3,56,900. This is the net taxable salary. Compute the income from salary. This is the income from salary. Got it, everyone? It is just a matter of presenting these things in the statement now. Have you understood the entire question and how the things are coming? Sure? Did you commit mistake anywhere? Now you realized that these mistakes are not to be done. Understanding? Perfect. Very good. Come to question number. Then I gave you fifth question. Which all questions we have done? One is done, no? One is also done. Two is also done. Now three. Three also we did right now, no? Three also done. Then four. Did I give you as homework? Did I give you 4 as homework? Oh, PF is there. No. Then 5 also not done. 7. We did this question yesterday only, no? My sister. Hello. Akanksha. So now we will be going to discuss PF. And with PF, the balance questions will be over. And then this chapter will be over. Shift out of 115 BSc. For what? This question, with the last question which we solved. Okay. Okay. Shift out of default tax regime. Not following 115 BSc. What are you saying? Seventh question. Okay. Seventh question. I told you all to calculate assuming that what if he shifts out. So what is your answer in that? Come on, tell me. Give me the answer. Did you solve this question, Kaushik? Seventh question, assuming that he is shifting out. What is your answer? Come on, tell me. Final answer. 620 will come. 420 will also come. 75 will also come. 9,000 will not come. 9,000 will come as taxable, but you will not get deduction. Or you will get deduction. No, you are not going to get deduction because you are not a government employee. Then medical expenses reimbursed. 18,000 will come. 4,000 professional tax. Now you are going to get the deduction for professional tax. Yes or no? Then health insurance premium not to be done. Gift vouchers to be taken. Then on your calculator, please. 6,20,000. Take on your calculator 6,20,000 plus 4,20,000 plus 75 plus 9,000 plus 18,000. Now plus 2,000 professional tax paid by the employer. Then plus 10,000 plus 26,000 also plus 39,600 and plus 7,000. On your calculator, you must be getting 12,26,600 only. Getting, no? Now 50,000 standard deduction you will take. And you will also take the deduction for professional tax 4,000. You will not take any deduction for what? 16 clause 2 entertainment allowance because you are not a government employee. Done. So after 1226 600, you will reduce 50,000 and you will also reduce 4,000 professional tax paid. So what will be your total now? 1226 600 minus 54,000, 11,72,600. Everyone getting this answer? Sure. Perfect. Kaushik, you solved this question or not? Solved, no? Very good, very good, very good. Very good. Perfect, perfect. Done, friends? Sure? Okay. This is our employee. Okay. Employee is getting salary. We call it gross amount, right? From whatever gross salary which he is getting, sometimes an amount is deducted by the employer. So whatever salary he'll get, from that salary, some amount will be deducted by the employer. So that amount will be deducted by the employer, saying that, see, we are making some plans for your, we are making some good things for your future. And what is that good thing? That good thing is your PF, Provident Fund. So in your Provident Fund, no, you'll have to contribute so that you get money in the future. See, you are not the only person who is going to contribute. Along with you, I will also contribute. Because in India, there are PF laws. There is PF law in India. That PF law compels every employer to, from his pocket, also contribute, and compel the employees also to contribute in their PF account. So just imagine, if I'll give you the entire salary, you are my employee, and if I'm giving you the entire salary in your hands, you will spend the entire salary. And the amount which you were supposed to contribute in your Provident Fund, which is required by the law, you are not going to contribute that. So rather than giving you the full amount of salary, whatever contribution which is to be made in your PF account from your income, from your salary, I will deduct that amount and deposit that amount in your Provident Fund. Yes or no? Provident Fund is what? It is a retirement benefit only. Yes. So for your retirement, we are planning right now that at the time of your retirement, some money is saved so that your rest of the life which is remaining after you become old, that is spent comfortably. So to spend that life comfortably, you need to save money from today itself. So from where you will save your money? From the salary which I am going to give you. From there only you are going to save, no? But just imagine, if I will give you the entire salary, you are not going to save on your own. You will spend that entire money. So, and if you will spend your entire money and if you will not save for yourself, no, the law is going to kill me being your employer. I will be penalized. That I'm not, I'm not compelling you. I'm not motivating you to contribute here. So we don't take such kind of risk, employer. What we do, whenever we give salary, from that salary only we deduct some amount as your contribution and we will deposit that amount in your Provident Fund. Getting my point? So from your salary, some amount will be deducted as your PF contribution. And then a net amount of salary, this amount will come to you in your hands. Getting my point? So from your employer, this amount was supposed to come, but he is not going to give you this amount. No, he is going to give you this amount in your hands, this amount. So what he will do with this amount? He will deduct, take that amount with him and deposit in your PF account. Getting my point? So what I'm going to do now, employer will give this salary. From that salary, this amount will be deducted and this amount will go to your Provident Fund, also known as PF account. This is mandatory to be done. Okay. Now your employer will also put some amount from his own pocket. Hello. In your PF account, he will also put some amount, contribute some amount. So can I say there are two amounts coming in PF account? One amount is your own contribution from your salary. That is known as this amount, color, yellow color. This amount is known as employee's contribution coming inside the PF. And some amount from employer will also come here as employer's contribution. Color, orange color. Now your PF balance will keep on growing. Slowly, steadily, it will keep on growing. And on that PF balance, PF amount, the amount which is there in your PF account, on that, on periodic basis, interest will also come. So interest at certain percentage will also be credited, because this amount will not be kept idle. This will be invested somewhere. By investing that amount, returns will be there, and from that returns only this interest will be credited. Okay, so this is the next amount. Color, blue color. Interest is also coming inside the PF. So now three amounts which are going in the PF. Every month from your salary, your contribution will be deducted and it will go in the PF account. From your employer's pocket also, every month some amount will go to your PF account. And on periodic basis, maybe on a quarterly basis, maybe on a yearly basis, some interest at certain rate will also be credited in your PF account. Now there will be compounding here, because the interest which will go, that will also add to the balance. Interest will be there on your contribution also, interest will be there on the employer's contribution also. Getting my point? Now the slowly and steadily the PF balance will keep on growing. It will keep on growing. It will keep on growing. And just imagine if this thing happens for 20 years of your employment. After 20 years when you leave, some employees will leave after 25 years. Some employees will leave after 30 years. Some employees will leave after 15 years. So this phenomenon, for example, if you are leaving after 20 years, so within 20 years, just imagine how much balance this account will have. That will be a very decent sum, huge sum. So that lump sum amount, whatever is there in this PF account, that lump sum amount will come out of this PF. Now from this PF, a lump sum amount will be given to you. And that lump sum amount will be coming out of the PF. Getting my point? The amount is coming out of PF. See the arrow coming out. Now this amount of lump sum will be given to whom? This will be either given to the employee only, if he retires prior to his death. So on his death, if he is retiring prior to his death, meaning that his retirement happens before his death. So on retirement, this amount will become due in your hands and it will be given to you. But what if the death happens prior to retirement? Then whatever amount which remains here will become due on your death and will be given to your legal heirs, your nominees. Getting my point? So this lump sum amount can be given to the nominees or legal heirs also. So it is given to the employee on retirement or separation from the employer, or it is given to the nominees on death of the employee. Yes or no? My dear friends, this lump sum which is coming out of PF is known as retirement benefit, which we did not do that time. Now we are supposed to talk about this lump sum first. First we will talk about this lump sum. Then we are going to talk about this also. These three amounts coming. So these will be contributed while you are in service. So while you are in service, what will be the tax treatment for these three amounts? That also we are going to see. But when you will retire, at the time of retirement when you are going to get this, what will be the tax treatment of this? So there are 2 points in times. One, you are working and the amounts are getting contributed. And amounts are coming in the PF. So while you are on job, while you are in service, what will be the tax treatment of these amounts under the head salary or under the Income Tax Act, which are coming in the Provident Fund account? And once you retire or you die, then this lump sum which was there in the PF account, that becomes due either to you or to your nominees. At that time, it will come to you or your nominees as what? Retirement benefit. What will be the tax treatment at that time? Getting my point? Everyone? So first of all, tell me one thing. We'll have a discussion about this lump sum first. Okay. But to have that discussion, I must tell you one thing, that the PF account for which we are having a discussion right now, that PF can be of three types. That PF can be either statutory provident fund known as SPF, it can either be RPF known as recognized provident fund, or it can either be unrecognized provident fund UPF, or someone can say URPF, unrecognized provident fund. Whatever type of PF is there, the concept remains the same. Employee will contribute from his pocket, employer will also contribute, periodic basis interest will also be credited at certain rate, and the lump sum will come out of the PF account. SPF also this thing will be done, RPF also this thing will be done, and UPF also this thing will be done. But the tax treatments depend on the type of provident fund, that what type of provident fund is there. Based on that, the tax treatment will be different. Getting my point? But for you all to know that tax treatment, first you will have to understand what is SPF, what is RPF, what is UPF. Getting my point? So first of all, if I talk about SPF, SPF is what? SPF is statutory provident fund. So this is a provident fund which is set up and administered by the government for its own employees under the PF Act 1925. There is one law in India. The name of that law is PF Act 1925. So that PF Act requires the government to set up a fund and to administer, to run that fund for the benefit of its own employees. So as per the requirement of this law, the government has made a provident fund, and that fund where all the employees of the government or government sector or public sector or even railways, LIC, public corporation, big universities, their employees will have an account in this provident fund, which is statutorily to be made as per the provisions of this law. Made and to be run by the government only. So a provident fund which is set up and administered, set up and run. Administered means it is being run by whom? By the government for its own employees. So usually which type of employees will have their contributions going in SPF? Those employees will be government employees. Those employees will be the employees of public sector, public limited companies, big public limited companies. Yes or no? Big universities, railways, LIC, etc. The employees of these organizations, statutory corporation, etc. These employees will have their PF account in the statutory provident fund. They will have this PF account made by the government. Getting my point? In this PF account, what will happen? Employee will contribute from his salary. Employer will also contribute, meaning the government will also contribute, and the interest will be credited at a regular interval. And whenever the employee retires or he dies, whichever happens earlier, at that time the lump sum amount which was there in the PF account will become due and will be given either to the employee or his legal heirs. That's it. Will you remember this much? Sure, everyone. Now coming to RPF. RPF stands for Recognized Provident Fund. Okay. Now what is this Recognized Provident Fund? Two things are there. See, the employer in private sector shall open PF account of all his employees in with the central government. So central government has already made a PF, provident fund. In that provident fund only, for all your employees, you will be required to open an account with the government. Being a private sector employer. And the private sector employer will do it if this employer has 20 or more employees during the financial year. If you are having 20 or more employees, be ready now. For all your employees, you are supposed to open your account for each of your employee with the central government, with the PF account maintained by the central government. Getting my point? And the moment you open this account with the government, in the government provident fund, if you are opening the accounts of your employees in this provident fund, then automatically that account becomes recognized by the income tax department. Income tax department recognizes that, okay, you have opened the account for all your employees. We recognize this because the account is opened with the government PF. Understanding? So with the government provident fund, the provident fund which the government is maintaining, in that provident fund only, all your employees PF account is opened there. No need to take separate approval or no need to take our recognition for that, because we actually recognize. Whether you tell us or not, we come to know from the government only. Government is going to tell us to the income tax department that, see, this employer has opened these many accounts of employees with us. So we recognize it. Recognize means known to the income tax department. We know it. We are aware about it. Recognized. Getting my point? Hello? Every employer having 20 or more employees has to do this. But wait. An employer in private sector, the employer having private sector and its employees together can set up and administer their own provident fund. We are now not going to the provident fund of the employee, provident fund of the central government. We will set up our provident fund on our own and we will run the provident fund on our own. Getting my point? And in this provident fund, the account of all my employees will be open. Getting my point? Now to do this, the employer and its employee together can set up and administer their own PF. To do this, employer should have greater than or equal to 100 employees. And all employees unanimously agree to do this. Meaning not a single employee should be against it. All the employees should be with this decision of the employer. So all the employees unanimously, along with the employer, they decide that we are not going to open our account with the central government, in the central government's provident fund. No, we will be setting up our own provident fund and we will run that PF on our own. So now for this provident fund, for this own provident fund, Number one, approval from PF commissioner will be required. Number one, first approval. PF commissioner should approve this provident fund. And number two, it must be recognized separately by Chief Commissioner of what? Income tax. Meaning that it must be recognized by the department. But before recognizing, take the approval of the PF commissioner. Once your PF commissioner approves that okay, you can set up and run such type of PF. After his approval, come to us. Tell us that you have made such type of provident fund. You will be running this type of provident fund on your own. So we will then recognize based on certain conditions. Getting my point? So this will be process. Here there is no need of recognition. Why? Because the account is opened with the central government itself. So whatever accounts of your employees opened with the central government, approval from PF commissioner and separate recognition from income tax department. Not required here. Not required. Automatically, this becomes automatically it will be treated as what? RPF, recognized provident fund. But this will be recognized only after it is approved by PF commissioner and recognized by Chief Commissioner of Income Tax. Only then it will become recognized provident fund. Getting my point? Now to do this, there is a requirement in the law. There is some law in India which compels the employer to do this. That if you have 20 or more employees, you are supposed to open a PF account with the government for all your employees, each of your employee. There is a requirement under a law. Which law says? PF Act 1925? No, that is made for government employees. Another law is there, and the name of that law is Employees Provident Fund and Miscellaneous Provisions Act 1952. As per the requirement of this law, the employer has to do all these things. Getting my point? Now who has opened the account? Employer. For whom? His employees. With the central government. That account is automatically RPF account. No need to take separate approval and recognition. But if you are having 100 or more employees and you and all your employees unanimously decide that we are not going to open an account with the central government, we will set up our own provident fund, we will run the provident fund on our own. Then that provident fund needs to be first approved by the PF commissioner, then recognized by the income tax department. Only then it will be treated as what? Recognized provident fund. Understanding? And this recognized provident fund is set up and run by a trust. A trust will be formed. Trust will have trustees. And who will be the trustees? Few representatives from employee side will become trustee here. Few representatives of employer side will become trustee here. And a trust will be formed. And on the name of that trust, the provident fund will be made. And that provident fund will now be run by this trust only. Getting my point? This is the requirement of Employees Provident Fund and Miscellaneous Provisions Act. But what if there are more than 100 employees and all the employees are not getting ready for doing such thing? Then employer has to compulsory open their PF account with the central government, which will automatically be RPF only. Got it? You ask this thing to any of your friends that what is RPF and how it is set up. They'll not be able to answer you. Friends, there are three types of provident fund. One is SPF, one is RPF, one is UPF. Come on, tell me. Yes. Okay. How many types of provident funds are there? SPF, RPF, UPF. Sir, what are they? Don't worry about them. There are three types of provident fund, SPF, RPF. Nobody is going to tell you that what is the logic behind how they are formed. And once you understand this thing, no, now you'll go for that tax treatment and all, no, that will be retained in your mind for long durations of time. Getting my point? What I'm trying to tell you all. Okay. So now there is one more provident fund. The provident fund which is not yet recognized. That is not illegal. There is no requirement of recognizing it as of now. So what I have done, I have made a provident fund. A trust is formed. On the name of that trust, me and my employees together, we have formed a PF account, a provident fund, and that provident fund, we have taken the approval from the PF commissioner. PF commissioner has approved it. But there was no need of taking the recognition as of now. Okay. As per the Income Tax Act, there was no requirement of taking the recognition. Later on, whenever the requirement will be there, we will be taking the recognition also of the same provident fund. See, right now I am having only 15 employees. Am I required to open a RPF account for all my employees? No. But still, PF account is, Provident Fund is set up right now. Still, Provident Fund is set up and we are running that Provident Fund. Getting my point? And then that Provident Fund is yet to be recognized by the Income Tax Department because there are certain conditions which I might have to fulfill. Based on the satisfaction of those conditions, now the recognition will be given. But till that time, that fund is not recognized by the Income Tax Department. It is what? Unrecognized Provident Fund. So both RPF and UPF will be maintained by private sector employer for their own employees. And the SPF is set up and administered by government for its own employees. Got it? So if I write UPF, what is the full form? UPF means unrecognized provident fund, and this provident fund is set up and administered by the employer only, but not yet recognized by the Chief Commissioner of Income Tax, that is Income Tax Department. So till the time it is not recognized by the Chief Commissioner, it is what? It is unrecognized. Whenever it is recognized, whenever there is a need to open a recognized PF, that time we will not open a new recognized PF account for all my employees. We already have UPF, we'll get the balance converted into RPF. Getting my point? Understood this much? So in SPF or RPF or UPF, what will happen? In any type of provident fund, employee will contribute from his salary. Employer will contribute from his own pocket. Interest will be credited on a periodic basis. The amount will keep on accumulating. So whenever the employee dies or he retires, whichever happens earlier, at that time, whatever accumulated balance which was there in the provident fund, known as lump sum amount, that lump sum will become due, which can be given to the employee on his retirement, or it can be given to his legal heirs, nominees, if he dies prior to his retirement. Got it? Sure, everyone? So you know what is PF now. Now I'm just supposed to tell you the tax treatments. So first tax treatment we'll discuss about what? This lump sum amount. See, lump sum amount coming from any provident fund on the death of the employee will not be taxable in the hands of legal heirs because it is a capital receipt for them. Getting my point? So on the death of the employee, if the lump sum amount becomes due, and that will be received by the legal heirs or the nominees, that will not be taxable in the hands of legal heirs nominees because it is received on the death, capital receipt for them. We are supposed to discuss about this part. If that lump sum is received by the employee on his retirement or separation. Now, let's have a discussion about this. First part. I'm not talking about the first half of the movie. See, this is a movie itself. Before interval and after interval. Before interval, meaning before retirement, what is happening? Contributions are happening, interest is getting credited. But after the interval, what is happening? Lump sum is coming. So I'm talking about lump sum first. I'm talking about that story which continues after what? Interval. Getting my point? So whenever you will get the lump sum in the future, so that lump sum is coming from what? Lump sum meaning the accumulated balance. Coming from, come on, tell me, can it come from SPF account? Can it come from RPF account? Can it come from UPF account? It can come from any of these accounts. Now, if the lump sum is coming from statutory provident fund, SPF account, that entire lump sum which is coming now will be fully exempt under section 10 subsection 11. There is one section 10(11) which says that this entire lump sum will be exempt. Now RPF account, if lump sum is coming from RPF account, then that lump sum will also be fully exempt under section 10 subsection 12. And pay attention here. Ting ting ting. Conditions apply. This 10-12 exemption will be given only in following situations. And what are those situations? I will tell you. Give me 2 minutes for that. But before that, if the RPF lump sum is coming as a result of these situations, only then the RPF lump sum will be what? Exempt. Otherwise, it will be assumed that the lump sum is not coming from RPF, it is coming from UPF, and it will be taxable in the same manner in which the UPF lump sum is taxed. Hello? So if you are receiving RPF lump sum in these situations, I will be writing these situations, okay, no? In these situations, if you are receiving lump sum from RPF, only then the RPF lump sum will be exempted under section 10(12). But what if you are receiving lump sum from RPF, but that lump sum is not received under these situations? Then it will be assumed that the lump sum is not coming from RPF, it is coming from UPF. It will be assumed. And the taxability of that lump sum will be in the same manner in which the UPF lump sum is taxed. Hello, sir. Understanding? So now I will have to tell you that what is the taxability of UPF. Then we are coming to RPF again and we'll see these situations. Okay, everyone? So first of all, UPF account, from UPF, whatever accumulated balance was there in UPF, tell me what balance would be there in that UPF. These many years employee has contributed, so employee's contribution is there. These many years employer has contributed, so employer's contributions are also there. In this entire lump sum coming from UPF, there will be 4 things. Number 1, starting till today, how much the employee has contributed for these many years. That amount will be there in this lump sum. Starting till today, how much amount employer has contributed here for you. Total employer's contribution will be there in this UPF. Understanding? Can there be interest on the employee's contribution interest would have also been credited on employer's contribution. So there are four things now. This UPF lump sum will be divided into two parts: contributions and interests. What did I say? Contributions and interest. Contribution by the employer, and interest on employer's contribution, interest on employee's contribution. These four amounts will be there. So that entire balance, what did I say? That entire balance coming from UPF, accumulated balance of the UPF, will be divided into these four parts. Okay. So first thing, come on, tell me. First thing will be in this UPF, contributions will be there and interest will be there. Interest, contribution by employee will be there and contributions by employer will be there. Interest on employer's country will also be there and interest on employee's country will also be there. Getting my point? Now sir, how to determine these amounts, that how much employee's contribution, how much? You are not supposed to do that. The amounts will be given, don't worry. They will be saying that this much lump sum is coming from, this much accumulated balance coming from UPF. In this accumulated balance, this much was the employee's contribution so far. This much was the employer's contribution so far. This much was the interest on the employee's contribution. This much was the interest on the employer's contribution. You just remember the tax effects, that what is to be done with which amount. Now tell me, one simple question I will ask you. Simple question I'll ask you. From where the employee will contribute? Any provident fund, the employee will contribute from his salary only, no? So first year salary, some amount deducted, contributed in UPF. Second year salary, some amount deducted, contributed in UPF. Every year from your salary only, the amount is getting contributed. But every year, the salary after deducting PF contribution, net salary is not getting taxed. Every year, the gross salary is getting taxed. 100 rupees was your salary, out of that 10 deducted and going to your PF account. So net 90 you are getting, but are you showing 90 as taxable or 100 gross as taxable? Always you are showing gross as taxable. So in that 100 rupees, you have already shown this 10 rupees as your income in that year and already paid tax on that, no? Now that 10 rupees which you have already shown as your income was contributed in this PF. First year 10 rupee contributed, second year 10 rupee contributed, third year 10 rupee. This 10 rupee is coming out of your salary only, no? So every year whatever salary which gets taxed in your hands, out of that salary only you have contributed these amounts, no, as your contribution. And now that is coming back to you. Is it your income again? No, ignore this, because this has already suffered tax as salary in earlier years. Hello sir, getting my point? So from your entire lump sum, separate this part which is employee's contribution in that lump sum. Getting my point? This will be, my dear friends, ignored. This will be ignored. Now tell me, whatever contributions are going to your PF account from your salary, on that your contribution you are getting interest also. But that interest was never shown as your income that time. But now that is coming, that has to be your income. See, the income, salary income, which has already suffered tax, out of that salary, some amount is going in your PF. That is coming back to you, is not your income, but that is bringing some extra income in the form of interest. That is your income. Hello? That should be taxable. So I am talking about interest on employee's contribution now. Tell me, interest on employee's contribution is income. Taxable under which head? salary? Is it coming because of employer-employee relationship? Or the amount which you contributed as your investment in your PF, on that it is coming as return. Hello? So any return in the form of interest on your investment has to be your income from other sources. So treat this amount taxable under the head income from other sources, and not your contribution coming back to you, because that is not your income only. But on your contributions, whatever interest was credited, even that amount is coming back to you, that you treat as IFOS income. Hello, sir. Will you remember this? Now tell me, this employer contribution and interest on employer contribution. For these many years, employer was contributing. Hello. For these many years, employer was contributing. And on that contribution of employer, interest was also getting credited. If the employer would have wanted, he would have given this amount to you as salary only. But instead of giving this amount to you as salary, he decided to put this amount in your PF. So what if instead of giving you salary, the employer would have told you that, see, I'm not going to give you this much salary right now, because if I will give you this much salary, this will become your taxable income right now. So what I will do, this much amount I will not give you in your hands, I will pass it on in the PF along with interest. So if I want to pay you 6 lakh rupees of salary, no, this year, I will not give you 6 lakh rupees of salary in your hands. Rather, I will contribute 5 lakhs, and on that, full year interest will be accruing 1 lakh, total 6 lakh will be credited in your PF account. And that will later on come to you as what? Lump sum from UPF. Just imagine, if this amount is not taxed, everyone will start taking their salary from the employer like this only. Employer, don't give us salary. Instead of salary, give us this type of benefit. Put that salary in our PF account. So that salary which you are not giving right now will not be taxable. Amount went in our PF account. Hello? And that amount along with interest will come to us, and we will say that we are getting what? The lump sum from the PF. That time also it is exempt. If it was exempt, then everyone would have started taking their salary in this way. So can I say this amount directly employer could have given to you as what? Salary. But instead of giving you this amount directly as salary, he passed on this amount through UPF. But ultimately this amount is coming from employer's pocket only, no? Employer's contribution also and interest on that. Both the amount coming from employer's pocket, not directly to you, but it is routed through what? UPF. Salary not given. Some profits happening in lieu of salary. Hello, sir. Employer is giving you some profits in lieu of salary. Will not give you salary, but will get you such type of profits. Will give you such type of profits in lieu of your salary. So can I say this will be profit in lieu of what? Your salary under section 17 subsection 3, and this entire amount will be taxable as your income from salary. Got it? So employer's contribution and interest on employer's contribution, both the amounts in your lump sum. Separate that amount will be taxable under the head salary as what? Profit in lieu of salary. Employee's contribution, separate that amount, it will be ignored. It is not your income only. But the interest on employee's contribution will be your income. But that will not be taxable under the head salary, because that is return on your investment. That will be taxable under the head IFOS. Will you remember this tax treatment? Sure, everyone? Pakka? Let's check. Come to one question. Five was done, no? Come to question number 6. This is a question on PF. Let's see. Mr. A retires from service on 31st December 2024. So he is retiring on 31st December 24. After 25 years of service, okay. Following are the particulars of his income, investments for the previous year 24-25. He is getting basic salary of 16,000 per month for 9 months. Sir, why 9 months he will get? From April till December only he is into employment, no? So from April to December, 9 months only he is going to get the basic salary, no? Hello, sir? Because on 31st December when he'll retire, after that he is not going to get any basic or any allowances, etc., no? So for first 9 months he is going to get what? Basic salary in this year. Then dearness pay, meaning dearness allowance, is 72,000. How that 72,000 is coming? They are saying that this dearness allowance is 50% forms part of the retirement benefits. And that dearness allowance is 88,000 per month for 9 months. 8,000 into 9 will give you 72,000. But out of that 72,000, 50% forms part of retirement benefit, means 50% is in terms and balance 50% is not in terms. 36,000, 36,000, 36,000 in terms, 36,000 not in terms. Hello? Both are taxable. So basic salary also taxable, DA is also taxable, in terms, not in terms, both are taxable. Yes or no? And lump sum payment, put a star mark on this. Lump sum payment received from the unrecognized provident fund. How much is that lump sum payment? 6 lakh. Now out of this 6 lakh, whatever will be the employee's contribution will be ignored. Interest on that employee contribution will be taxable under IFRS. But out of the 6 lakh, whatever will be the employer's contribution and interest thereon will be taxable under the head salary. Yes or no? Just now we have discussed, no? So deposit in the PPF account. See, whenever you deposit some money in PPF, PPF means Public Provident Fund account. So money is coming or money is going. You are depositing money, meaning the money is going, no? That is not your income. That is your investment. So this investment happening in PPF account, Public Provident Fund account, will allow you to take deduction under ATC. So for this, you are going to get deduction under ATC, PPF account deposit. Hello, sir. In ATC, we are going to see this amount again. So in this year, whatever amount you are investing in your PPF account, the PPF account of your spouse, PPF account of your children, that entire amount which you have deposited in this year will be allowed as a deduction under ATC, subject to limit of ATC. Getting my point? So this is your contribution, your deposit, your investment in PPF is not your income. It is investment. It is deposit. Money going out will allow you to take ATC deduction. Getting my point? Now they are telling that out of the amount received from the UPF, meaning that they're talking about the 6 lakhs now. Out of the amount received from UPF, they're talking about the 6 lakh. Okay. The employer's contribution was 2 lakh 20. Interest thereon was 50,000. Don't you think that this 2 lakh 20 and 50, 2 lakh 70 entirely will be taxable under the head salary as profit in lieu of salary? Hello, sir. Understanding? Now tell me. Now what I will do? The employee's contribution was 2 lakh 70 and interest thereon 60. No need to tax employee's contribution because this is already considered as salary in the earlier years. Hello, already taxed. Now coming back to you will not be your income. But interest on this amount amounting to rupees 60,000 will be taxable as your income from other sources. Getting my point? Now what is the taxable portion of amount received from the UPF in the hands of Mr. A? They are just asking you that. Then why other details are given? Just to confuse you. They are telling you, they are asking you what will be the tax treatment of the 6 lakhs. So out of the 6 lakh, 2 lakh 20 and 50,000, employer's contribution and interest thereon will be taxable under the head salary as profit in lieu of salary. 2 lakh 20, sorry, 2 lakh 70, employee's contribution coming back to him will be ignored. Not taxable anywhere. Not an income only. 60,000 interest on employee's contribution will be taxable under the head. IFOs. That's it. See the solution. Got it? But wait, in your question only, write down one thing. In the question only, can you see the blank space? Use this blank space and write down what I am dictating you. Also compute taxable income under the head salary and total income of the employee, of Mr. A. So what will you do now? Come on, tell me. They're telling you to calculate taxable salary also and total income also, meaning that they want you to take this IFOS also, GTI, take the ATC deduction also, total income. Getting my point? Give me the answers. Come on, fast. In that question, write down one more line. Assume that employee is not following 115 BSc, meaning he is shifting out from 115 BSc. Yes or no? Computation of total income. First of all, to compute this total income from salaries you have to take. So income from salaries. First thing is basic salary, which was how much? 16,000 into 9. And that amounts to 1,44,000. Outer column. Second one is dearness allowance, and it is in terms also, which is 1 lakh, sorry, which was 72,000 into 50%, and not in terms also. I will write down like this. Wait, I will write down like this. 8,000 per month into 9 months. This will be 72,000 and 50% of that. Again, 8,000 per month into 9 months, 72,000 into 50%. And this will be 36,000. This will also be taxable. And this 36,000 will also be taxable. Next, what he is getting? Lump sum payment. So what you are going to write down? Accumulated balance from UPF account to the extent of what? Employer's contribution and interest on employer's contribution. Why you are writing that under the salary head? Because it is profit in lieu of salary will be taxable under the head salary. Okay. So employer's contribution was 2,20,000 and interest was 50. So here it will be 2,20,000 and interest is 50. Okay. Now anything else given by the employer? No. Everything given total. So 1,44,000 plus 72,000 plus 2,70,000. Four lakh 86,000 you should get. This 4,86,000 is your taxable income under the head salary, income from salary. Yes or no? This is income from salary. Put A in front of this. This is income from salary. Now only this income you are getting in this year or other head income also you are having. You are having other head income, no? Income from other sources. So you will write down second head of income. Income from other sources. And under this you will write down interest on employees' contribution to UPF account received as a part of accumulated balance from UPF, and that amount was 60,000. No, so this 60,000 will now be your income from other sources total. But wait, we are yet to do something, because see, the salary which we have calculated, there was a mistake over here. What mistake was there? Because out of 4,86,000 we were supposed to take the standard deduction also, which we forgot to take. So standard deduction will come, no? This is your gross taxable salary. This is your gross taxable salary. And out of this, I will take standard deduction under section 16 clause 1A. And the amount will be 50,000, friends. Why 50? Because you are not following 115 BSc. Done, no? Now there will be net taxable salary. Total will be 4,36,000. This 4,36,000 will be your A. This will be your salary income, salary head. Now write down IFRS here. Now it is okay. Now IFRS will be total how much? 60,000 only, no? Only one income under the head IFRS. B. Any other head of income can you see in the question? House property, capital gain, PGBP? No, na? So all other heads nil. You have only these two heads. Now from these two heads, what are you going to do? Total. The total will be gross total income, A plus B. So it will be 4,96,000. Everyone got this? Out of this you are going to get deduction under section ATC, PPF deposit. So ATC amount maximum deduction is 1,50,000. How much is your PPF deposit? More than 150 or less than 150? Less than 150, no? PPF deposit. Check how much was PPF deposit. 40 only, 40,000. So 40,000 is within the limit of 1,50,000, because under ATC you cannot take the deduction more than 1,50,000. Yes or no? So full 40,000 you can take as deduction because it was within the limit of 1,50,000 ATC limit. Now do the total. You will get 4,56,000. This is your total income, my dear friends. And see, they will tell you to calculate the tax liability also on this. This type of small case study can be there in your exam. And from this case study, they will make small MCQs. 2 plus 2 plus 2, 6 marks. And if not case study, this question can come independently also. Ayo sir, we saw the same question in the ICI study mat. We did the same thing, still we did not get the mark. Why? Because same question they will give, but they will change the required part now. Required part in that ICI study mat is what? Tell me, what is the required part? Only tell what will happen with the lump sum, that's it. But what if they are twisting the same thing, they are twisting and telling you to calculate the taxable salary? Then you stop here. Then you stop here, that's it. But what if they are telling you to calculate gross total income? Then stop yourself here. What if they are telling you to calculate total income? Then take the PPF deposit as ATC deduction and stop here. This will give you full marks. But wait, they will go one step ahead and they will tell you to calculate the tax liability also. Come on. How will you calculate the tax liability? You will apply the tax rates. Which rates you will apply? 115 BSE you have shifted out. So 115 BSE shifted out. So normal tax rates you will apply. Entire income is normal income. Hello. On that you will apply the tax rate up to 2 lakh 50 basic exemption limit, 2 lakh 50 to 5 lakh. You are not going 2 lakh 50 to 4 lakh 56, 2 lakh 6,000. On that you will apply 5%. That 5% will be your tax. And that tax you can claim as rebate also. Because your total income is up to 5 lakhs. Rebate will also come. So entire tax will go for rebate because the tax will be less than 12,500 only. Final tax liability will be nil. This type of question can come for 10 marks in the exams. Understanding, you just thank God that I don't set your papers for ICA. If I'll set your papers, no, I'll not allow you to pass also. Only those students will pass who read between the lines, who are serious in their studies, who know that what is asked, what I am understanding and what I am writing. If these things are not matching, no, forget about getting the marks in the exam. So first, what is asked? See that. Are you understanding what they are asking? Okay, very good. Now, give them that same answer which they are asking. If you write anything else, no, you are not going to get marks. Okay. Now this we have solved, assuming that is not following 115 BSc. Same question. They will tell you, assessee following 115 BSc. What will you do? Sir, this will remain same, 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 this will remain same. Only this will change. This will become 75,000. So sir, accordingly this will change. Sir, if this will change, no. So this will also remain same. Under the head IFOS will not change. IFOS will also remain same. Getting my point? Sir, this amount will change. So now instead of 436, what will be the total here? This will be 75,000. Hello? 75,000. And this will be how much? Reduce 25,000 more. This will be 4,11,000. This will be 4,11,000. Yes or no? And 4,11,000 plus 60 will give you how much? 4,71,000 as your GTI. And from that, if you will take the ATC deduction, you are gone. Because ATC deduction, chapter 6A, all the deductions are not available from your GTI if you follow 115 BSc. Then why are you taking this ATC? So this will not come, and ultimately your total income will also be 4,11,000. And on that, if they are asking you to calculate the tax, what you will do, now you will not apply that tax rate which you have studied. Now 115 BSc tax rates will be applied. 115 BSc tax rates are different. I have already told you earlier that I have not yet taught you, which we are going to do with the total income questions. Getting my point? How miserable your life they can make. Just see. Understood? Should I move ahead? Sure? Perfect? Okay. Now pay attention. Now let's come to that part again. Where? See here. UPF lump sum taxable in 4 parts. Taxability you understood? If the lump sum at the time of retirement coming from SPF, that lump sum is fully exempt. None of the part will be taxable. Employee's contribution, ignore. Employer contribution, interest, employee's contribution, interest, fully exempt, 10, 11, because it is coming from SPF. Because SPF will also have these 4 parts. But the entire SPF lump sum is exempt. So nothing will be taxable. RPF lump sum will also have these 4 parts. Hello, sir. RPF lump sum will also have these same 4 parts. But that will also be fully exempt under section 1012. Provided you are covered in these situations now, which we are going to tell you now. If you are not covered under this situation, then RPF lump sum having these 4 parts will have the same tax treatment which you are giving for UPF. Employees contribution, ignore. Interest on employees contribution, IFOS. Employer's contribution and interest thereon taxable under the head salary. That's it. But if you want to take the exemption, you have to get yourself covered in any of these situations. Yes or no? First situation. Continuous service of 5 years or more. So are you getting RPF lump sum? Yes. And that lump sum is received by you after giving a service of 5 years or more, then it will be exempt. Meaning that at least stay in the employment for 5 years or more, no? Then take that lump sum. We are going to exempt that. Then the amount will be a good amount. And that we will exempt. Amount will also come, which will be a big amount, good amount. And your employer will also be, in a peace of mind that, okay, this employee is not going to leave us for at least 5 years. Getting my point? With the same employer. Wait, with the same employer. Right now I am talking about same employer. But later on it can change also. But first of all, provide a continuous service to your employer for a period of 5 years or more. If there is some break, no, with the same employer, then also counted. There is a break and you are joining a new employer, then also it is counted. But how it is counted, that we are going to see now. Getting my point? So first, 5 years or more service you are supposed to provide. Then you are getting RPF lump sum fully exempt. Order. Okay. Next one, 2. Just imagine if you have not given 5 years or more service. You are leaving the employment within 5 years. Within 5 years you are leaving. Have you provided services for 5 years or more? No. You are leaving the employment before that. Will it be exempt now? Yes, it can be exempt because now you will be covered in second part. Reason, continuous service of 5 years or more? Yes. Then it will be exempt. But no. Then you are covered in 2. 2 says that reason for leaving not in control of employee. Hence he has left within 5 years. I did not want to leave within 5 years because I knew that I am going to get the lump sum from RPF and I wanted to take the exemption. But what to do? I had to leave. The reason for my leaving within 5 years is not in my control. Company closed down the business. What should I tell the company? I've just completed 3 years. Continue the company for 2 more years so that my 5 years are completed. I cannot request that, no. Company is getting liquidated. Company is getting amalgamated. So the new company does not want our services. So I have to leave within 5 years. I become very ill. The doctor has told me to have complete bed rest. I cannot move from my bed also. And as a result of that, I had to leave within 5 years. The reason is not in my control. So there can be n number of reasons. You have to see that if the reason for leaving the job within 5 years was not in your control and then you are getting RPF lump sum in your hands, then it will be fully exempt. Even if it is within 5 years, still it will be exempt. because the reason for leaving the employment was not in your control. But what if answer to this is no. Reason for leaving the employment not in your control. No, it was very well in my control. I left, I resigned. Then you will be covered in third point. Now, don't take that lump sum in your hands. Get that lump sum transferred to your new employer where you are going to work now. Leaving the employer, resigning from the employer within 3 years. X Limited you left within 3 years. So instead of taking that money, RPF lump sum in your hands within 3 years, that will be a premature withdrawal. Hello, don't take it in your hands. Wait, you are going to join a new employer, Y Limited. Y Limited is also required to open a RPF account for you. Tell Y Limited not to open a new RPF account. Get your RPF account from X Limited, get it transferred to Y Limited. Instead of taking the money, get it transferred to new employer. Then also it will be fully exempt. Getting my point? So if RPF account transferred to new employer, that means the money you have not taken in your hands. Getting my point? You have got it transferred to new employer. So whatever money which was supposed to come to you in your hands from RPF, is it coming to you or it is getting transferred to your new employer? It is getting transferred. So that amount which is getting transferred to new employer, no, not coming in your hands, will be fully exempt. Don't worry about that. Will not charge tax. Even if you left within 5 years. Now, new employer you have joined. What is your new employer? Come on, tell me. Y Limited? With Y Limited, you worked for another 3 years. Now, Y Limited will contribute in that same RPF account in which earlier X Limited was contributing and you were contributing when you were the X Limited employee. So, in those balances only, now the new balances will accumulate with Y Limited. How many years you have provided service to Y Limited? 3 years. Now, when you leave Y Limited, no, only the balances when you were the employee of Y Limited, is it going to come to you or the earlier balance will also come to you? So will you take only 3 years of employment or earlier 3 years of employment also? 3 plus 3 becomes 6 continuous employment. Getting my point? 6, which is 5 years or more. Now whenever you will get that money from RPF, no, after leaving Y Limited, that money is not coming after leaving within 5 years. No, that money is coming after a continuous service of 5 years or more. This will be treated as continuous. Even if there is a break, don't take that money. Get it transferred to new employer. And the service which you will be going to give to the new employer, no, even that service period will be counted with the earlier service period. And both taken together will total be your continuous service period of 5 years or more. Got it? So that time it will be taxable. If the services rendered by you to Y Limited was only 1 year, so 3 plus 1 is 4 only. Continuous service of 5 years or more? No. That time it can be taxed. Getting my point? Hello, sir. So working for 5 years or more and RPF amount coming, fully exempt. Working for less than 5 years, RPF amount coming will be fully exempt if the reason for leaving the employment was not in your control. Hello. Working for 5 years or less, reason for leaving the employment was in your control. Still you left, still you resigned. Then get the amount transferred to new employer, then also it will be fully exempt. Hello. But what if you are not getting the amount transferred to new employer because you are not joining any employer? Then at least get it transferred to NPS account of the central government. Now this third part is not there. The answer to this third part is also what? No. The answer to this third part is also no. That you are not getting the amount transferred to new employer. You are not joining any new employer. Yes or no? Then whatever RPF balance which was supposed to come to you, at least get it transferred to NPS account. Open a national pension scheme account with the central government, and in that national pension scheme of the central government, get this amount transferred over there. then also it will not be exempt. Sorry, then also it will be exempt. Hello? But sir, if the answer to this is also no, meaning that you have not got the amount transferred to NPS also, now this amount is definitely going to come in your hands. You have not get it transferred to new employer. You have not got it transferred to NPS. Now this amount is definitely going to come in your hands. And now this is coming within 5 years. And the reason was beyond your control. No, reason was very well in your control. Then it will be treated as premature withdrawal from RPF. Within 5 years, withdrawal is happening. Then the taxability will be done exactly in the same manner in which UPF was taxed. Hello, sir. Understanding? Sure. Should I move ahead? Lump sum done. First things first. I will ask you, you will answer. Everyone, pay attention. On retirement or separation, lump sum is coming from SPF. Entire lump sum, there will be 4 parts. Employees contribution, interest on employees contribution, employers contribution, interest on employers contribution. This entire lump sum, which contains these 4 parts. First part, employees contribution, is not an income only. That is not taxable only. But the other 3 parts are taxable. No, employers contribution and interest thereon will be taxable under the head salary. Interest on employees contribution will be taxable under the head IFOs. These 3 parts are taxable, but the first part, employees contribution, is not taxable. This will be there for all SPF, RPF and UPF. But if it is coming from SPF, no, entire lump sum exempt. Forget it. If it is coming from RPF, no, then also entire lump sum exempt. 10, 12. Hello. Provided you are covered in any of these situations. 5 years or more, continuous employment. Then RPF balance coming to you, fully exempt. Oh, within 5 years, left the employment and RPF balance coming. Still it will be exempt provided the reason for leaving is not in your control. Oh, reason was in your control and you are resigning. Then also it will be exempt provided it is transferred to new employer. Oh, not transferred to new employer. Don't worry. Get it transferred to NPS. Then also it will be fully exempt. Oh, not transferred to NPS also. Now the amount will definitely come in your hands. You have left within 5 years. Amount is coming in your hands. And the reason for leaving employment was very well in your control. This is a premature withdrawal. Will be taxable exactly in that 4 parts in which the UPF is taxed. UPF is taxable. Everyone knows this. Hello, sir. Will you remember? This will happen when you will receive these amount in future. This will happen. But to get these amounts in future, to see this taxability in future, right now something should happen. What should happen? You have to contribute. From where you will contribute? Come on, tell me. From your salary of this month, this year, you will contribute to your SPF, RPF, UPF. Hello? Entire salary tax, no? From that only, this contribution is going, no? No effect to be given under the head salary because entire salary you are already taxing. Hello? No effect to be given in salary. Entire salary tax. And from that salary only, the contributions, your contributions are going, no? Will you again give effect to this amount under the head salary? No. Effect is already given by taxing the entire salary, gross salary. Hello? Do only one thing. Your salary taxed. Hello? Out of your salary, your contributions going. It is investment by you. Out of your salary income, you are investing. Where? SPF, RPF, UPF. So out of your salary income, whatever investments you are making to SPF and RPF, for that you will get deduction under 80C from your GTI. But the contribution made by you from your salary in UPF will not be allowed under 80C. Right now under the salary head, no need to give any effect. Getting my point? Hello? So what I can say, number 1, employees contribution during the relevant previous year to SPF to RPF to UPF. This contribution will be out of employee's salary only, no? Now I'm not talking about what will happen in future. Lump sum, no, that is already done. But to get that thing in future, I need to contribute right now, no? So in my previous year, I am contributing. In previous year 24-25, whatever salary was there, from that salary I am contributing now. Is my entire salary for this year, gross salary is taxed? From in that amount, I have already counted this, no? Net amount, gross minus this, net was there. Did I charge net under the head salary, or I charged gross? I charged gross. In the gross, this amount is already treated as my income under the head salary. No need to give any effect under the head salary for this amount now. Do one thing. When you will calculate your GTI, no? In your GTI, are you going to show your entire salary? Yes. And from your salary, whatever investments are happening in your SPF, RPF, for this you claim deduction under ATC. But that you are going to take after GTI. Yes or no? And UPF is not recognized only by the income tax department. Income tax department does not recognize only that such type of provident fund exists. So the fund which we do, we don't recognize that fund only, and you are saying that you are contributing in that fund. How do we trust you? Hence, no deduction under ATC. Whatever amount contributed by you from your salary to UPF account will not be allowed under ATC. But whatever amount contributed by you from your salary to SPF to RPF, they are approved funds. Getting my point? You will get the deduction for those under ATC. Got it? Now two more things are to be done. Employer's contribution to your RPF account and interest credited to your RPF account. This year, will your employer contribute? Sure. To SPF, to RPF, to UPF. He is going to contribute. Now, if he contributes, that amount becomes due to you right now. Are you going to receive that amount right now or later on as a part of lump sum? So, whatever amount which will be contributed by the employer right now, this amount is neither becoming due in this year nor you are receiving in this year. It will become due, it will be received by you as a part of lump sum at the time when you will get retired. Hello? Fully exempt. Fully exempt. SPF, UPF. What did I say? SPF, UPF. And by the way, tell me, whatever amount your employer is contributing to your SPF, your employer will be government only. Government is contributing to your RPF. Government is contributing to your SPF. Will the government contribute excess or whatever exactly required, only that much? Definitely. If you are a government employee and as per PF Act, whatever amount the government is required to contribute to your SPF, the government is going to contribute that much only, no, which is legally required. Government is not going to contribute a single penny in excess of the required amount. The amount which the law will say, which is required to be deposited in your SPF, the government will only take that money out of pocket and will deposit in your SPF account. So the amount contributed by your employer to your SPF will be legally genuine amount contributed. Hello? Not becoming due right now, not received right now. So not taxable right now, fully exempt. But when this amount will come as a part of lump sum, hello? So whatever amount which is coming as a part of lump sum was genuinely contributed, no? That was legally required. That amount was only contributed, which is now coming to you as what? Lump sum. So lump sum from SPF is fully exempt. Why? Because that lump sum was the genuine amount, legal amounts which was required to be deposited. Only those amounts were deposited and which you are now going to get as what? Lump sum. That is the reason why SPF lump sum is fully exempt. Hello, sir. If I will tell you the lump sum later on, no, after explaining these things, you will not understand these things. What is happening? Why SPF lump sum? Sir, you said exempt. SPF lump sum is exempt because in that SPF lump sum, whatever amounts which are contributed right now are what? Genuine amounts which are getting contributed, which are becoming due, which are received at the time of retirement. So at the time of retirement, the entire lump sum amount is a genuine amount for these years coming back to you. Legally required, nothing extra your employer is contributing. Only that much which is required is contributed and received as a part of lump sum. Hence that lump sum is exempt. Getting my point? Right now, when the employer will contribute, what will happen? Right now, no tax treatment, fully exempt, because the amount is contributed in your SPF. No. Is this amount becoming due to you right now? No. Is this amount received by you right now? No. Employer is just contributing to your SPF row. And that amount, which is contributed by the employer right now, neither becoming due to you right now, nor it is received by you right now, not taxable for you right now, fully exempt. So can I say second point, if employer's contribution during the current previous year happens to your SPF account, neither becoming due to you right now, nor it is received by you right now, hence fully exempt. And this entire amount which is contributed right now is the legally genuine amount which the employer should contribute. Employer would have contributed that much only, nothing more, nothing less. And now this amount, when the lump sum will become due, when it will be received by you at the time of your retirement, this amount will come as a part of your lump sum. Meaning your lump sum contains genuine amount only. So your lump sum should be exempt. Got it? Tell me, can your employer contribute to your UPF account? Can he contribute? So he is putting money in your UPF, macha. Is he giving that money in your hands? Is this money becoming due to you right now? No. So not taxable right now. Anyways, as a part of lump sum, when you will get this employer's contribution back, that will be taxable as profit in lieu of salary only. So if this amount when becomes due, when it is received on retirement, at that time if this amount is getting taxed as a part of your lump sum, so why to tax it right now? It is neither becoming due nor it is received. So, sir, fully exempt. This also fully exempt. So this year, whatever amount your employer will contribute to your SPF, to your UPF will not be taxable at all. SPF when comes back as a part of lump sum, that time also fully exempt. UPF contribution by the employer will come back later on as a part of lump sum. That time it will be taxable as profit in lieu of salary. Hence it is not taxable right now also. Hello, sir. Now there is some problem in RPF. Come on, tell me. Can your employer contribute in RPF? Very important discussion. Very, very, very important discussion. Can your employer contribute in your RPF? Now, who will make RPF? Come on, tell me. Employer in private sector only will make RPF account. Will open an RPF account for the employee. Now, you tell me that, sir, RPF amount this much you are contributing. From my salary, you are contributing 10,000 every month, meaning 10,000 into 12, 1,20,000. So that amount goes from my salary. For that, I will get later on, I will get what? ATC deduction. Sir, you are also supposed to contribute 120, no, sir? So I said, yes. Matching contribution usually happens. So whatever amount which I deduct from your salary, that much only I will also contribute. So I am also going to contribute 10,000 per month, meaning 1,20,000. You said, sir, don't do that. Sir, contribute double. Don't contribute 120, contribute 240. I said, why? You will say, sir, if you don't give me 1,20,000 of taxable salary, no, that taxable salary along with your contribution, which you should do. You should do how much? 1,20,000. That is genuine amount. But along with that, don't give me 1,20,000 of salary. Rather, that 1,20,000 also, along with your contribution, that 1,20,000 also you contribute as your contribution to my RPF. Meaning, You are telling your employer to contribute your taxable salary to your RPF account. The contribution which should happen, that is happening. But over and above that also, some part of your taxable salary you are telling your employer to contribute in your RPF. Why are you telling this? Right now, whatever amount will be contributed by the employer, not becoming due, not received by you because it is going in RPF. So not taxable. Entire 2,40,000 contributed right now is not taxable. As a part of lump sum, when this employer contribution will come, entire 2,40,000, which I have contributed right now. Hello? Since you have provided services for 5 years or more, at that time it will be fully exempt. So your taxable salary, which should be given to you right now, on which you should have paid tax, you are telling your employer to contribute that amount in your RPF so that it does not get taxed as salary for current year. Now it goes into your RPF. Now it will be received entire amount which I have contributed right now. That entire amount will come back to you as a part of lump sum from RPF. And you've already worked for 5 years or more. Entire lump sum, which includes this amount also, will be exempt. Tell me, last 7-8 years or last 5-6 years, all the employees will start doing this. This will be a tax planning stuff. So they are saying that wait, if an employer will contribute to your RPF, no, there will be a maximum limit for that contribution. There is no such maximum limit for SPF or UPF. See, for SPF, no, genuine amount is only contributed. So we are not worried about that because the government cannot do such kind of stuff with the employees. If you tell the government to contribute extra amount, taxable salary in your SPF, government will throw you out. Government is not going to do that in SPF. SPF, this kind of stuff cannot happen. UPF, even if it happens, ultimately it is going to be taxed only. Hello? When you receive it as a part of lump sum, that will be taxed. Getting my point? But what about RPF? Right now also not taxed, and at the time of retirement also it will be exempt. There has to be some restriction over here. So guys, there is under the Income Tax Act, they are saying the RPF contribution, actual amount contributed by employer in the RPF for the current year, if that amount is up to 12% of salary of the employee, then it is okay. Then it is genuine. Then entire contribution made by the employer right now, because it was within the limit of 12% of salary. Hello? Entire amount was within the limit of 12%. So amount actually contributed. You have to see this amount. How much is employer contributing? This much. Now compare this amount with 12% of salary. You will have to calculate 12% of salary. This is the limit. And for this salary, what you will take? Come on, tell me. 12% of salary. What you will take in this salary? You will take basic. You will take DA incomes. You will take turnover commission. That golden rule. Guys, come on. Basic DA incomes, turnover commission. You will get salary. 12% of that salary. What did I say? 12% of that salary is the maximum limit. So for example, your basic DA incomes and turnover commission was 15 lakhs. How much was that? 15 lakhs. Basic plus DA incomes plus turnover commission, meaning your salary was 15 lakhs. Take 12% of that. 15 lakh into 12% will give you 1,80,000. Meaning that how much the employer can maximum contribute in this year? If your salary was 15 lakh, he can contribute 12% of that. Meaning that he can maximum contribute 1,80,000. This is the limit. Employer every month contributes 20,000. Meaning 20 into 12. How much actual contribution he is doing? 2,40,000. Is that 2,40,000 contributed is within this limit or more than the limit? Excess contribution over and above 12% will not be exempt anymore. That excess will now be taxable as your salary. Hello, wait. What if the employer is contributing only 12,000 per month? 12,000, 1,44,000? What was the limit? 180. So within 180 limit, 144 is okay, no? Nothing will be taxable because the entire contribution 1,44,000 is within the limit of 12%. Hello? Up to, then it will be exempt. But what if the contribution made by the employer in your RPF, if this contribution is greater than 12% of your what? Salary. Then what you will do? Then contribution up to 12% of your salary will not be taxed, exempt. But whatever contribution made over and above 12% of your salary, first of all, that excess contribution will be treated as your salary. 17 subsection 1, the definition of salary. 17 subsection 1, the definition of salary. The term salary includes. The salary includes number 1, wages. Number 2, annuity pension. Number 3, gratuity. Number 4, fees, commission, perquisite, profit in lieu of salary. Number 5, advance salary. Number 6, leave salary. Number 7, number 8, number 9, I did not explain that time. Number 6 says that whatever amount the employer has contributed to your RPF account in this year, which is in excess of 12% of your salary, that excess contribution made by the employer in this year will be treated as your salary. Even that is treated as your salary as per 17.1. Entire contribution or contribution in excess of 12%? Contribution in excess of 12%, meaning up to 12% it is not your salary. Forget it, fully exempt. But any contribution over and above 12% will be treated as your salary. So in our example, what was that? What was that? 2,40,000 contributed. And what was the limit? 12%. We calculated 1,80,000. So over and above 1,80,000, how much was the contribution? 60,000. That 60,000 is your salary now. We will charge that under the head salary. You said you cannot charge only, sir. Sir, you cannot charge only. Because this 60,000 which is treated as salary, in order to be taxed under the head salary, it has to become due in this year or it has to be received in this year. This 60,000 is merely going in my RPF, not becoming due right now, not received right now. So will not be taxable also right now. Hence, section 7. Incomes which are deemed to be received, which I left. Where? Scope of total income. Do you remember? As per section 7, any excess contribution by the employer to the RPF account of the employee will be deemed to be received right now only in this previous year. Not actually received. Not becoming due right now. Not actually received. But as per section 7, it is deemed to be received. Why it is deemed as received, you know? Because number 1, it is your salary. And we want to charge this salary in this year only. And we'll be able to charge it this year only if we deem to be received. So on deemed receipt basis, this will be taxable under the head salary right now. Now whenever on retirement, no, you will get lump sum. In that lump sum, you will get this entire 240 back. 240 contributed by your employer right now. That entire 240 you will get it back. In that 240, 180 will also come and this 60 will also come. That time it will be fully exempt. But right now, this was your taxable salary, which you got it contributed like this, will be taxable in this year itself. Got it, sir? So if your employer contributing to your RPF, employer contributing to your SPF, not becoming due, not received, nothing taxable, genuine amount contributed. And as a part of lump sum, if this amount will come, will be fully exempt. Understood? So right now, whatever contribution your employer will make, whatever amount is not taxable as your salary. Forget it. And as a part of lump sum also, it will be fully exempt. Right now, whatever amount your employer is contributing to your UPF, forget it. Not becoming due, not received right now, not taxable. Anyways, it is going to be taxed as a part of lump sum. 4 parts. Employer's contribution, interest on employer's contribution, interest on employer's contribution. This amount only will be received, no? which will be taxable at the time of retirement. Getting my point? As a part of lump sum. So right now don't tax. But what about the RPF amount? Employer contributing to your RPF account in this year. If the amount actually contributed is up to 12% or less than that, fully exempt, nothing will be taxable. Not becoming due, not received, not taxable right now. And as a part of lump sum also, when you will receive, will be fully exempt. Genuine amount, no, up to 12% it is okay. But if the employer is contributing in this year and the contribution made by the employer in this year is more than 12% of your salary, whatever excess contribution he is making in this year should have been your taxable salary. On that, you should have paid tax in this year only. But you told your employer to contribute in your RPF. Up to 12% genuine. Okay, perfect, no problem. But any excess over and above that 12%, no, that excess as per 17(1) will be your salary. And in order to charge that excess in this year only, since the entire 240,000 contributed right now does not become due, is not received. So in that 240, that excess 60 does not become due, is not received. So will not be taxed right now, even if we call it salary. Getting my point? So section 7, this 60,000, no, which is treated as your salary right now, even if it is not due right now, even if it is not received right now, as per section 7, it will be deemed to be received in this year. Accordingly, it will be taxable in this year only under the head salary. Now, whenever you will get the lump sum from RPF, no, in that lump sum, this 240,000 will come to you. That 240,000 will be fully exempt at that time. The 180,000 up to 12%, that also will be received, will be exempt. And this 60, which is getting taxed right now as salary, that amount will also be exempt at that time. But that has to be taxed right now. Got it? The same logic is for interest credit. Interest credit. Ready for that? Can the interest be credited to your SPF account? Third point. Interest credited during the current year. During the current year, whatever interest which is credited, it is credited to, come on, tell me, SPF account, RPF account, or UPF account? First question, apply some logic. Interest at whatever rate and whatever amount contributed at whatever rate, it is contributed to SPF. Just imagine. Genuine rate which the government will decide. At that rate only the interest will be calculated, and that interest will only be credited to your SPF account on a periodic basis. So this year, whatever interest which is going or getting credited in your SPF account, this year, whatever interest which is getting credited to your SPF account, the genuine amount which is required to be credited at genuine rate is only getting credited. Tell me, anything extra, will the government credit that? No, because it is SPF. And first of all, tell me, whatever amount credited to your SPF account as interest, is this interest becoming due right now to you? Is this interest received by you right now, or it is just getting credited to your SPF? Just getting credited, fully exempt, and full amount is genuine. Now this entire interest at whatever rate interest is calculated, this entire interest which is credited in this year was a genuine amount. Now as a part of lump sum, this genuine amount will only come. Hence that lump sum is exempt. Getting my point? In that lump sum, SPF lump sum, this interest will also be there, no? Entire lump sum exempt means this genuine interest will come as a part of that lump sum, which is going to be exempt. Got it? See, the reason for explaining that lump sum part first was this only. Otherwise, I was not able to give you these logics. Now you will remember throughout. UPF, whatever interest credited at whatever rate. This rate, 10%, 15%, whatever rate. And at that rate, whatever amount of interest credited to UPF. Is it becoming due right now? No. Is it received right now? No. Not taxable. And anyways, this interest will come at the time of retirement as a part of lump sum. Employer's contribution interest will go to salary and employee's contribution interest will go to IFS. Anyways, it is going to be taxed at that time. So why to tax it right now? So this also fully exempt, this also fully exempt. Will you remember this? Now there can be a problem in RPF. Come on, tell me. You will tell your employer to credit extra interest at extra rate to your RPF. Your taxable salary, you will tell your employer to credit in your RPF account because you don't want to pay tax on this salary right now. So you will either tell your employer to contribute that salary, taxable salary, in the form of employer's contribution, or you can tell him to contribute that salary in the form of interest credit to your RPF account. So your employer will credit interest at a higher rate. Whatever amount will be credited at a higher rate of interest, so that your taxable salary also gets inside your RPF. Is it becoming due? No. Is it received? No. Not taxable right now. And as a part of lump sum, after working for 5 years, as a part of lump sum, entire lump sum is exempt. So this interest which was extra, which was your taxable salary, which got contributed right now, that will also get exempt at that time. So there has to be some restriction over here also. So they said RPF, in the RPF account, if the interest is credited in this year, and if it is credited, any amount credited, but that is credited at 9.5% rate of interest or less. So the rate of interest, rate at which the interest is getting credited, that rate should not be more than 9.5%. So at 9.5% rate, the interest is calculated and credited, fully exempt, no problem. At 8% rate, interest is calculated and credited, fully exempt, no problem. But we will have a problem when the interest amount is calculated at the rate of 12%, 14%, 15%, hello, 10.5%. Interest amount is calculated at a rate which is higher than 9.5% rate. So whatever excess amount of interest which relates to excess rate of interest, that will not be exempt anymore. That will also be treated as your salary. But since it is not becoming due right now, not received right now, so could not be taxed, no. Section number 7. This excess interest over and above 9.5% rate credited to your RPF, even this excess is your salary. And as per section 7, this is also deemed to be received right now. Hello? Are you getting the logic that why I left section 7 that time? Why I left section 17 subsection 1, last 2-3 points I did not discuss, and this is also salary, this is because I wanted to cover all those things. I wanted to link those things here. If I would have spoken anything about these things that time, no, you would not have understood a single thing. Getting my point, sir? So tell me one thing. Interest, this time, total interest credited at the rate of 8%. And the amount of that interest was 1,60,000. Possible or not possible? Total amount total amount credited is 1,60,000. But that 1,60,000 is calculated at 8% of some amount. So interest is credited at 8% rate only, no? What is the maximum rate? 9.5%. If credited at 9.5% rate or less rate, whatever interest credited, fully exempt, no problem. But what if this 1,60,000 was credited at the rate of 16%? Interest credited 1,60,000. Wow. And this was calculated at what rate? 16%. Meaning at a rate which is higher than 9.5%. Wow. Meaning interest in excess of 9.5% is getting credited. So if this amount is 16%, how much interest should have been at 9.5%? Come on, calculate. This will be 95,000. Hello, cross multiplication. And many people will take 9.5% of 1,60,000. Do it. I will come in the exam and give you a tight slap. That's 1,60,000 itself is 16%. How much should have been the interest if only 9.5% interest was there? Cross multiply, no. If 16% is 1,60,000, how much is 9.5? On some amount, 16% is calculated. That becomes 1,60,000. So 1,60,000 is 16%. On that same amount, if 9.5% would have been calculated, how much would have been your interest? That would have been 95. So what is the interest credited in excess of 9.5? It is 6.5% interest credited. Yes or no? And that 6.5% interest which is credited, how much is that amount? That amount is 65,000. Can I say this is excess interest credited to your RPF? This is your salary for this year, 17-1. But wait. Not becoming due right now, not received right now. So what? As per section 7, deemed to be received in this year. Taxable under the head salary. Now, whenever your lump sum will come, in that lump sum, this entire 1,60,000 will come. In that 1,60,000, 95 will also come and this 65 will also come. 95 will also be exempt, 65 will also be exempt. But right now, out of 160, 65 will be taxed. So that it becomes exempt later on. Got it? Same. End of PF. Now, one or two small discussions are remaining that I'm going to do in the next lecture. And we are going to solve all the questions. So we thought that the major chunk of the chapter should be over today. It is over. No worries at all. Tomorrow we are not going to take much time to finish this. Tomorrow we are finishing with this chapter and we are going to start with the new chapter tomorrow itself. The new chapter will be PGBP, profits and gains from business or profession.